Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
This reform is not just on rationalizing rates. It's also on structural reforms. It's also on ease of living, so that businesses can do their business of working together with the GST with a great ease.
Well, that's the finance minister late night announcements, and absolutely historic. India has ushered a new GST regime. That's point number one, big rate rationalization. Government's big consumption boost. I mean, the across the board GST cuts. And by the way, as CNBC-TV18 reported, so it has been across the board, every single item. Will this lead to a big consumption boost, especially on the mass market side? That's a big question. And of course, the important bit, rate cuts are from the 22nd of September, which basically means that they capture the festive season. They're not, very delayed. They're not sort of to be implemented from a far out date. They are from the 22nd of September. That's very important. And of course, two slab structure, 5%, 18%, in terms of where the rates now stand. The 12 and 28 is gone. Most of 12 is in 5. Most of 28 is in 18. No cess, 40% for sin and luxury goods. So very few items in the 40% category. We will talk about that as well. But there is no cess on top of it. 40% is the maximum rate. And as I said, all CNBC-TV18 news breaks confirmed from the first to the last, every single one of them. And I think it's a proud moment for all of us here. You're with us here on a slightly early start on Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surbi and Nigel. Guys, good morning.
Hi, guys.
Morning.
Good morning. What a GST bonanza, a GST blockbuster. I don't think we have enough adjectives. It was announced on the 15th of August by the Prime Minister from the ramparts of the Red Fort. It's been delivered. And you know what really stood out for me? This was supposed to be a two-day meeting.
Yeah.
It all got wrapped up in day one. And, all kudos to Timsy out there, because she told us exactly what those proposals were going to be. And it's, I think digit by digit, percentage by percentage, that's exactly what the council has approved.
Well, that's right. Timsy has been bang on over the last few days, and we here at CNBC-TV18 have reported almost everything that actually did come out officially, and we were reporting late into the night. But today, the markets got what it wanted. So, Prashant, let's get straight to the action.
Absolutely. Surbi, by the way, you stayed up the wrong night. The day before yesterday, right?
No, I was awake. Watching. And you know what? The Prime Minister, remember the last council meeting? She must have said, you guys made so much of fun of the popcorn business and the caramel and the salted. I'll give you the big one this time. And that's the way she announced in the press conference.
Absolutely. Let's take it from the top then, right, in terms of what you need to know. The big major GST rate rationalization announcements are through. That's essentially point number one. And we'll get into individual stock sectors in just a bit from now. And of course, as we told you, all our news breaks are confirmed. So the new GST structure is effective 22nd of September. So the government's been cognizant of the fact that they don't want purchases to be deferred because, there'll be lower rates sometime down the line. They're right now, which means that the start of the festive season. And in that sense, they've thought that through as well. Expect improved affordability to give a fillip to consumption. I mean, of course, the question really is how much, and that will depend from sector to sector, company to company, and we will get you a whole variety of responses to this as we go along. 12%, 28% are gone. 12's mostly moved to 5. 20 has moved to 8. New 40% slab for sin and ultra luxury goods. But there is no additional compensation cess above the 40% rate. And I think this is a very important point. So the maximum rate here now is 40%, which is I think, crucial and critical. So GST rates either remain unchanged or go lower for most items, except maybe, apparels above a certain value and things like that. Otherwise, across the board, it's either a cut or they remain where they were earlier. So I think this is very, very good. As I said, we'll get to stock sectors in a bit. I just want to tell you about US equities, etc. as well, slightly higher. So no real headwind from there. US markets were sliding a little bit, starting to crack a little bit, but 0.5%, 1% on the S&P, NASDAQ respectively. The 10-year was down about 4 basis points. Dollar index was down about a quarter. Oil prices, they went down 2.5%. And there were reports, Reuters reported that OPEC is meeting on Sunday. They may consider another output increase. So maybe oil's got more to go here, which is not exactly a bad thing. Now, just the levels, right? Tying in the levels. Nifty yesterday closed slightly above the 20-day moving average. Maybe the market got a bit of a whisper. So starting 1:30 yesterday, the Nifty zoomed. It was a two-day meeting. Announcement came late last night, but maybe the market got a bit of a whiff, at least at the index level. Immediate resistance is the 61.8% retracement of the fall. The recent fall, by the way, which is 24,878. That's the first stop. And we'll see if we've got enough in the tank. I think we do for the market to at least get to the upper end of the range. Support stands at the low, which is 24,404. The Nifty bank resistance again is a 61.8% retracement of the recent fall, 54,777, and the support stands at 53,561. So I think we are in for a good session on a headline overall basis in terms of individual stocks. We'll have to see, depending on pre-positioning, what has done well, what has not done well, etc. GIFT Nifty is indicating a 150-point higher start. Let's get the F&O set up. Positioning, I think that's important. Nigel is standing by. Nigel.
Well, that's right. The markets have got what it wanted, right? And that's why the GIFT Nifty is suggesting a gap up. But at the end of today, you'll want to end with these gains. The question is, will this GST rationalization be enough to trap the bears on the wrong side? That's going to be very, very important. And in today's trade, a couple of sectors will be in focus. NASDAQ ended high. You normally see a bit of a positive rub-off on the Nifty IT index. As it has been an underperformer. Yesterday ended lower as well. So that will support one end, while the consumption stocks as well should do well. But the big mover really will be if the Nifty bank, that after a while outperformed yesterday. We saw a bit of a short covering bounce that played out there. That's the key. Can the Nifty bank find its form and at least move in line with the Nifty, if not lead the way? That's going to be the important mover for today's trading session. What happened in trade yesterday? Well, the institutions for the last few trading sessions, they have been net buyers. And yesterday was no different because the DI buying it offset the FI selling. And that's been the trend for the last few trading sessions. So that's a positive. But in the index futures, we're looking at what did they do? What did the FIs do? Well, in fact, there was no short covering yesterday. On the whole, there was some short addition that we saw. The short positioning is at an extreme level of around 92%. And in the last few trading sessions, we have seen a bit of a bounce. And actually, the FI net short positions from around 1.68 lakh contracts, that's gone all the way to around 1.82 lakh contracts. So that big short covering bounce that we are talking about, that's yet to take place. And that will give bulls some kind of hope that that's still in the offing. Even if you don't see the big cash market buying in from the FIs, these shorts in the system should hold us in good stead. Moving to the options data, then you have a couple of strikes that were active. The 24,700 call. Well, there was some addition yesterday's trading session. From the high, actually, there was some unwinding. So that's going to be the crucial mark. While on the downside, the 24,050 put, that did see a good amount of open interest build up. So going by the options data and going by the recent resistance, we did a U-turn from around the 22,750 mark, 24,750, 24,800. That's going to be the important mark, while support comes in at around 24,400. The Nifty bank, the 20 and the 100 DMA, that's the range that you're looking at in terms of a resistance mark. So we'll keep an eye out on that. While the stock that we're looking at is, yesterday towards the end of trade, we said RBL Bank is likely to move into the F&O ban, and that's precisely what's happened. So that's the stock we'll keep on the radar.
Okay, all right. Globally, just remember one more headline to keep in mind, that the U.S. administration has moved the Supreme Court. There's no date yet as to when the court will rule on that 50% on the overall reciprocal tariffs, but it should happen in the next couple of weeks. Let's straight away get to the big story, which is leading to this 150-point pop on the Nifty as of now in terms of the implied open. We have our sector specialist standing by to decode the impact of the mega GST cuts. We've got Mangalam to talk FMCG. We've got Sudarshan revved up on autos. Nigel in a bit will tell us more about cement, and Upasna and Vamakshi also joining. Upasna and Vinny also joining in with their sectors. Let's get started. Nigel, you take it away first. As expected, 28% goes to 18% for cement.
Well, that's right. That was a long-standing ask, and that's what's come about. Jeffries has said for the government itself, they lose close to 20 to 25,000 crores in terms of revenues. But what's the impact for cement? Well, it's a sentiment positive, actually, that's coming out. Because cement demand, as we all know, demand is inelastic. because the cost of making an affordable house, only 12 to 14% comes in from cement, and for a modern house, in fact, it's only around 5 to 6%. So effectively, this cut in terms of GST doesn't move the needle too much for urban housing in particular. It could help in terms of rural housing. The GST cut, well, if GST comes down, the price in all probability should be cut down in a proportional manner. But part of this pricing may not be passed on, and that's why the street is optimistic it will flow through to margins. It could lead to people consuming premium cement, which comes at a higher realization, so that's important, and it could help volumes as well. The duty on coal, that's moved up, but it's unlikely to hurt them because there was a cess of close to around 400 rupees that's going to be done away with. So net, it's no impact on the negative side for the cement consumers. And finally, one overhang could be the states will get relatively less GST now. From around that 14%, they'll get around 9%. Will it hurt some part of the incentives? But otherwise, net, it's positive for the cement sector. Hopefully, volumes pick up.
All right, Nigel, thanks very much for that. So that's cement, maybe a fillip to volumes we will see, and we'll get your reactions, as I said, across all these companies. Auto components and tires. Sud is standing by. Sud, morning.
Good morning, Prashant. So it's a big GST reset, and auto is expected to be one of the biggest beneficiaries after GST Council's approval for the GST rationalization. So first headline, it would be a GST rate cut across the auto segment. Second, smaller cars, bikes up to 350cc capacity and auto parts move into 18% slab from earlier slab of 28%. Now, third, luxury cars or say bikes having capacity of more than 350cc will move into 40% slab. But effective tax rate, even at 40%, would be lower than the tax rate that it used to be earlier, because earlier it had the compensation cess, which goes away now. Second, big headline, EV will remain in 5% slab. And last headline is tractor and the parts used in tractor will come down and move into 5% slab. So which all companies will be biggest beneficiaries? First one is Maruti, because it has the huge exposure in small car segment. Also amongst beneficiaries are Tata Motors and Hyundai. In the bike segment, Eicher Motors will be the biggest beneficiary because almost 86% of its total contribution come from bikes having capacity less than 350cc, and followed by that Hero Moto, Bajaj Auto and TVS Motor. In three-wheelers, three-wheeler also move into 18% category. Bajaj Auto and TVS will be biggest beneficiaries. Armored vehicles move into 5% category, and Tata Motors and Bharat Forge are expected to benefit. Bus also moves into 18% category, and Ashok Leyland and Tata Motors are biggest suppliers in the bus segment. Tires also move to 18%. So Apollo Tires, MRF, Seat, Balkrishna Industries will benefit the most because tires used in tractor segment will move into 5% slab. And last one is auto parts. Uniform rate is going to be 18%. So Endurance Technology, Bellrise, Sona Beardloo, Motherson and Crado are some of the companies which are expected to benefit. So it's all looking very positive for the auto sector today.
Okay, all right. Sudarshan, thanks very much for that. Let's move to apparel and textiles, because the finance minister announced yesterday that a lot of the inverted duty structure that was bothering the sector, that is getting ironed out with the GST changes. Vinny, tell us more.
Hi, good morning. So yes, in terms of apparels and textile side, there is a rate reduction that's come in for across those value chains, right? The input products that were used, that has now been reduced. So whether you look at yarn, sewing threads, man-made filaments, all of them have now come to 5%. So there is a uniform 5% rate for most of these inputs now. Man-made fiber earlier was 18%, moved to 5%. Man-made yarn earlier 12%, now moved to 5% as well. Now reducing these rates will obviously benefit and lead to a reduction in the manufacturing costs for the finished products as well. So other than that, we're seeing a reduction even in terms of finished products. So whether you look at carpets, rugs, bath linens, even apparel products, where we've seen a reduction coming in terms of the GST rates. For finished products, there's a reduction coming to 5% as well from previous 12%. Specifically for apparels, there's a GST of 5% on apparel products not exceeding 2,500 rupees. This turns out to be positive for Wellspun Living, Indocount, KPR Mills, Gokuldas Exports, Vardhaman Textile, Nitin Spinners, among some of these textile players.
All right, Vinny, thank you very much for that. Consumer durables is what we're going to focus on next. Upasana is here with impact on stocks. Upasana, over to you.
Good morning. Well, it's a big consumption boost with the onset of the festive season, especially. Let us look at the key categories that will be in focus on the back of the GST rate cut. AC, large TV above 32 inches, dishwashers, solar water heater, the GST on this is reduced to 18% from 28%, while other categories such as smartphones, refrigerators, small screen TVs, washing machines, microwave continue at 18% slab. Now, this big consumption boost is likely to increase the affordability for the consumers, especially ahead of the festive season, and lower GST directly stimulates the demand for ACs and large TVs, expanding the market size for domestic producers. Now, according to Elara Capital, RAC demand may rise minimum by 10 to 15% on the back of this, and RAC OEMs like Amber Enterprises, PG Electroplast, EPAC Durables may see spurt in volume growth on the back of this. Now, coming to TV category, there is no direct beneficiary here, but Dixon Tech will be in focus as it assembles TV for numerous brands in India. This might see a spurt in volume on the back of this in H2 FY26. Solar water heater, lastly coming there, it is a growing market in India, though it's not that substantial, but it is picking up, and key beneficiaries here would be V-Guard and Havells. So overall, it is a positive move for consumer durable sector.
Okay, all right, got it. Thanks very much, Upasana, for that. Back to Vinny. Pharma, healthcare, a whole range of medical equipment or consumables in hospitals. The GST has gone down on all of them. Vinny, fill us in.
Absolutely. So in terms of GST on medicines, all medicines has now come to 5% from previous 12%. There are 33 life-saving or important drugs that you could call, right? Out of that, 30 drugs are oncology drugs where there was a 12% GST previously. Now it's come down to nil. And there are 3 other life-saving drugs across different categories, which has been reduced from 5% to nil as well. So nil on important life-saving drugs. Now medical equipment, that's an important one as well. GST has been reduced from 12% to 5% for these medical equipments, whether you look at diagnostic kits, blood glucose monitors, surgical devices, bandages, among some of them which I'm naming right now in the medical equipment have seen a reduction as well. Now, obviously, this turns out to be positive for Polymedicure. Diagnostic companies also will benefit from this. So, Dr. Lal, Metropolis Healthcare, and other than that, companies that are domestic facing in terms, pharma companies that are domestic facing. So, Torrent Pharma, Abbott, Cipla, Zydus Life, Lupin, Sun Pharma will also benefit from the change in the drug prices.
All right, Vinny, thanks very much for that. Fertilizers and chemicals next. Vamakshi's got that. Vamakshi, morning.
Good morning, Prashant. Good news for fertilizer as well as agri-chem companies because, the inverted duty structure in chemicals has been corrected by reducing GST from 18% to 5% on sulfuric acid, nitric acid as well as ammonia. Now, this in turn bodes well for companies like Deepak Fertilizers, GNFC, Chambal Fertilizers, Coromandel, RCF, National Fertilizers, Paradeep Phosphates, FACT, Southern Petrochem, etc. Other than that, micronutrients as well as agri-inputs, the GST out here has been cut from 12% to 5%, and this in turn is positive for companies like UPL, PI Industries, Rallis, all of these agrochemical names, Bayer, Crop Science, Dhanuka, Best Agri-Life, etc. Now, keep in mind that these rates will be effective from 22nd of September onwards, and if we look at the impact, the reduction in input cost as well as the working capital relief as a result of correction in the inverted duty structure means better margins for fertilizer companies. And the second important impact is that it also improves affordability as well as demand uptick for micronutrients as well as agri-inputs.
Okay, it's a turbocharged booster shot across sectors, across companies. But how can we end without talking about FMCG? Those hair oils, the Maggi noodles, the chocolates, so on and so forth. Manglam, big day.
Big day. All the staples have been, brought under the 5% mark for GST. And that's a big positive. Why do we say that? Even if the companies go ahead and pass on, as is expected, all the benefits to the consumers, we will see increased boost coming, especially in the staples space. And that's what the FMCG stocks have been expecting over the last 10 or 15 days or so as well. So we have, HUL, Dabur, GCPL, Imami. Don't lose sight of something like a Bikaji as well, because all your bhujia and pre-packaged namkeen, etc. would come down from 12% to 5%. For nearly the entire portfolio of names that I just spoke about, all the rates have come down to 5% from 18%. So hair oil, shampoo, toothpaste, toilet bar, we have toothbrushes, shaving cream, all of them down from 18% to around 5%. Biscuits stand to benefit as well. The bigger benefit comes in from ITC, that's, because one, there is no incremental tax on tobacco. And secondly, some of its products, the likes of pencils, sharpeners, crayons, pastels, exercise books and notebooks have come down to nil. So that's a positive for them. The only fly in the ointment here would perhaps be something like a Varun Beverages. And the reason why I say that is because aerated beverages have been moved to 40% as against 20%. So the stock may be slightly negatively impacted, but a large part of the street, in fact, the entire street was penciling for that already. So barring Varun Beverages, all the other companies stand to benefit as the taxes are down to 5%.
And Mangalam, just very quickly, specifically on ITC, when it comes to cigarette taxation, no changes because I think there the compensation cess continues for some time.
The compensation cess continues. So currently what the regime is 28% GST, plus you have the basic excise duty, you have the NCCD, and you have the cess, which is basically a function of fixed and ad valorem, which is a proportion of the prices. Now, with the 28% having gone to 40%, there will be concomitant changes made to the other part of the taxes, so as to the overall incidence remains the same. Because if there is more incidence of tax on tobacco, then perhaps, there is risk of illegal or contraband gaining further market share and the government itself losing some sort of revenue. So it's only mature that it is tax neutral, and that's exactly what is understood so far from the details that we have.
All right, Mangalam, thank you very much for that. Just want to put out some views which are coming, and actually there'll be lots of views through the course of the day, but some street views, right? So this is Vikas Jain of CLSA, who writes this morning. He says the estimated reduction in the tax burden or increase in disposable income for consumers from these cuts equates to 30 basis points of GDP. This comes after a large income tax cut and multiple interest rate cuts over the last few months. This is the third significant consumption boost and gives impetus to our call for consumption stocks over capex plays. It goes on to say that lower indirect taxes will lower working capital needs and raise resources for ROEs, beg your pardon, for SMEs in the trade chain, boosting consumer confidence. The key direct gainers from these tax cuts are autos, FMCG, durables, cement, insurance, quick service retailer, that is QSR, and alcohol players as well.
Okay, so that's a view from CLSA coming through. Let's get you one from Jefferies as well. This is a view from Mahesh Nadurkar, who says the government's GST bonanza has come through and the government has moved swiftly to announce the GST cuts, with September 22nd being the implementation date. Festive demand hence should see a positive boost, though some negative demand impact would be felt in September. Most GST rate changes were expected or were on expected lines. Positive surprise came in for staples and ITC. Cement stocks haven't really moved since the August 15 announcement and should bounce now. And so should M&M, a strong positive for other autos also, but stocks have already moved up. So cement and M&M specifically, Jefferies calls out, should see a further leg up.
All right, let's just, and we'll get you more, right? So this is CLSA and Jefferies, but this is Finance Minister Nirmala Sitharaman addressing the media late into the night post the 56th GST Council meeting. Listen into some of the top announcements from the FM herself.
This reform is not just on rationalizing rates. It's also on structural reforms. It's also on ease of living, so that businesses can do their business of working together with the GST with a great ease. Rate rationalization, of course. We've reduced the slabs. There shall be only 2 slabs. And we are addressing also the issues of compensation cess. Ease of living, simplifying registration, return filing and refunds. Levied on common man's daily use items have gone through a rigorous looking into, and in most cases the rates have come down drastically. Labor-intensive industries have been given a good support. Farmers and agriculture as a whole will also benefit by the decisions we have taken today. Health-related also will benefit. So the key drivers of economy have been given a prominence. Man items such as hair oil, toilet soap, bars, shampoos, toothbrushes, toothpaste, bicycles, tableware, kitchenware and other household articles have all come to 5, whether they were in 18 or whether they were in 12. Similarly, reduction of GST from 5% to nil. 5 से 0 में जाने वाले आइटम्स इंडिकेट कर रहा हूं. अल्ट्रा हाई टेम्परेचर मिल्क, द UHT मिल्क, छेना और पनीर, all the Indian breads will see nil rate. Reduction of GST from 12% or from 18% to 5 इसमें फूड आइटम्स बहुत सारे हैं, नमकीन से भुजिया है, सॉसेस है, पास्ता है, इंस्टेंट नूडल्स है, चॉकलेट्स, कॉफ़ी, प्रिजर्व्ड मीट, कॉर्नफ्लेक्स, बटर, घी, ये सब 5% में आ रही है. From 28 to 18% on small cars and motorcycles which are equal to or below 350 cc. Reduction of GST from 28 to 18 on buses, trucks and ambulances. Uniform rate of 18% on all auto parts, irrespective of their HS code. Three-wheelers from 28 to 18 again. Reduction of cement from 28 to 18, क्योंकि घर बनाने में मिडिल क्लास के लिए सीमेंट इतना आवश्यक है, इसीलिए 28 it has come down to 18. Insurance services from 18% currently will go into 2-3 different categories. I'll say that to you. Exemption of GST on all individual life insurance policies, whether term life, ULIP or endowment policies, and reinsurance thereof, to make insurance affordable for common man and increase the insurance coverage in the country. Exemption of GST on all individual health insurance policies, including family floater policies and policies for senior citizens, and reinsurance thereof to make insurance affordable for the common man and increase the insurance coverage in the country.
All right, let's take that forward then in terms of insurance. Yash joins us to tell us how does it impact the insurance space. Morning, Yash.
Morning, Nigel. So, of course, let's address the headline first. GST on individual life insurance and health insurance has been exempted. Also, what has come along with it is that exemption has come as far as GST and the reinsurance cost of procuring that life insurance and health insurance policy is concerned. So that is as far as the GST rate is concerned. Now, as far as the sector is concerned, it would be one of the only sectors which has had its rate go down from 18% to exempt, but still won't be happy today. That's because it's a double whammy which has come with respect to the announcements yesterday for the insurance sector. One is that there is no input tax credit which has been announced by the government. The category of exempt does not give provision for input tax credit, which means that it will contain or restrict insurers' ability to offset any cost which they incur in procuring the life insurance or the health insurance premium. That is the first negative. The second negative which has come in is that the inverted duty structure has only been sort of corrected for the reinsurance cost which has been exempted. That is just 30 to 40% of the total cost which the insurance company incurs in procuring the health insurance or the life insurance premium. The balance 60-65% cost is commission as well as claims, but that's where the inverted duty structure still remains, which means the 18% GST on those services would still remain. I've been speaking to the industry players and worked out some numbers myself. Now, if the reinsurance cost would not been exempted on the reinsurance part of it, then it would have led to a 7 to 10% increase for insurance companies on every policy. But now, since the reinsurance cost has been exempted, that expense or the deficit on every policy comes down, but it still remains to be about 5 to 7% for insurance companies. Now, of course, there are three scenarios. Either the insurance company takes that hit on its own books of that 5 to 7% if that entire 18% benefit has to be passed to policy holders, or it shares that cost with distributors like Policy Bazaar, in terms of the commission.
Yash, thank you. Thank you very much. It's a complicated, I think out of all the sectors, insurance in terms of the GST cut impact is the most complicated one. But that's good explanation, and we'll talk to companies as well. But we are joined by Anish Shah, Group Chief Executive Officer and Managing Director of Mahindra Mahindra. Anish, good morning. Great to have you with us here. Glad that you're able to join us. Rajesh Jajurikar is also with us, ED and CEO, Auto and Farm Sector at Mahindra Mahindra. Rajesh, great to have you with us early and bright and early as well. Anish, if I can start with you, these are big rate rationalizations. You're smiling, you're happy in terms of what has been done. So your first reaction to what is done, and then specifically if you can tell us, Anish, what percentage of your fleet would now fall in the 18% slab and what percentage of your fleet would be in the 40% slab? 18 and 40, the two relevant rate slabs now. Go on.
Let me start first with the overall impact on the economy. And to me, that is the biggest factor in this change. It is a very dramatic one. It ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption. And this is something that should, in some ways, create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way. I'll let Rajesh cover the details from an auto perspective in specifics, but from an overall economic standpoint, this is a very, very positive move.
Fair enough. You're very positive in terms of the overall economic impact. Rajesh, if I can ask you then the specific bit, what percentage in the 18% slab and what percentage in the 40% slab? And of course, we will get to the tractor GST rate reduction as well, which I think is a big positive for Mahindra. Go on.
Yeah, so Prashant, like Anish said, we're delighted with the news overall. It's a huge enabler to demand and consumption. Markets have seen some kind of a slowdown over the last few quarters, and I think this will be a very good boost, timed very well with the start of the festive season. To the specific of your question, I actually want to, you got to see the auto and farm business, which is key part of the M&M Limited company, as a sum of three key segments. The tractor segment, which is tractors and farm machines, the commercial vehicle segment, and then the SUV segment. So tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. And that on an average basis, we do about 35 to 40,000 volume a month. Then we have the pickup portfolio, which is LCVs less than 3.5 tons, which will move from 28 to 18, which is about 25,000. So I'm just giving you these broad numbers so that you get a context of the volume. Our SUV portfolio is in the region of 45,000. Roughly 40% of that will be in the 18% and 55-60% will be in the 40%. But we have to keep in mind that we also have EVs, which will be in the 5%. So overall, if you kind of, were to leave out the 40%, we have a very large chunk of volume pickup plus SUVs in the 18. And then we have tractors and EVs in the 5%.
Rajesh, around 40% in the 18% overall. Would I be okay in the ballpark?
No, it will be higher when you add the pickups, the commercial vehicles. So it will be almost 65% when we add the commercial vehicles as well.
In the 18% slab.
Numbers, it includes commercial vehicles as well.
Okay.
Yeah. Mr. Jejurikar, hi, good morning, sir. And Mr. Shah, thanks so much for joining in, both of you. Mr. Jejurikar, if I could ask you, I know it's very early, but maybe your team has already done the back of the envelope calculations. If we talk about the full revenue of the automotive segment, let's leave aside farm equipment. So if you talk about full year revenue, then is there a way of gauging that, what part of the portfolio, with the volume breakup that you just gave us, what part of the portfolio or what percentage of that revenue gets a positive leg up because of the reduction to 18%? And what part perhaps, which will be few, which go into that 40% category? So that percentage of the revenue, perhaps you have to see how the volumes play out.
No, every part of the portfolio will get a volume up, Surabhi, because 40 is also benefit of 8%. So what was in 40 was 48%, including the cess. Yes. Even there's an 8% benefit. So every part of our portfolio gets a leg up. EVs are unchanged, but everything else gets a leg up between 8 to 13%.
Yeah. And the other question, and maybe Mr. Shah can also come in on this. Overall, sir, what's going to be the thought process? I mean, does everything get passed on to the customer? Or, will you have to take a slightly more nuanced call on this? depending on other input prices and other compulsions. I mean, how do you look at it? Should, for M&M and the industry across the board, do you expect all of this to be passed on or not? Mr. Shah?
We expect all of this to be passed on. This is meant for the consumer, and the GST cut should be passed on to the consumer in full.
All right. Hi, good morning, gentlemen. Thanks a lot for joining in. Rajesh, coming across to you, you said the tractor rationalization of GST costs will ultimately bring the tractor cost down by how much?
50 to 60,000, depending on the horsepower category.
50 to 60,000 rupees, right?
7%, yeah. 40,000 to 60,000, depending on the horsepower category.
Got it.
That's
and
the 12 to 5%, 7% drop.
Okay. All right. Got that. But what about in the interim? This comes into effect from 22nd. So in the interim, will that create some kind of uncertainty, postponement of buying? How do you see customer behavior move?
There will be transition issues, Nigel, and in any transformation, there's going to be transition issues. So, we would expect the next three weeks or so to see some kind of a wait and watch. There are some issues related to compensation cess, which SIAM will take up with the government separately. But overall, I think the sentiment is very positive, and we see this as a very long-term demand driver. There will be a little bit of wait and watch through September, which may affect September volumes as customers wait and watch for the effective date of 22nd September.
And Rajesh, you're saying including CVs, 60% of the portfolio will be in the 18% bracket now, right? That's what you said.
60% of the auto portfolio. If you add tractors, it's higher.
Of course.
Which is at 5%.
Yeah. Anish, can you give us a slightly top-down view on, what you began by saying, right, which is the consumption boost and what it does to growth overall? Because, the second derivative, third derivative, etc., can be quite meaningful, which is very difficult to immediately put numbers to. So just your thoughts there, Anish.
So what we've seen is the economy has grown roughly at about 7% or so for the past couple of years. And as a result, private investment hasn't gone up as much. Capacity utilization has gone in the 75 to 80% range for many industries. So, Prashant, as we think about the economy overall, I strongly feel that this could be the one factor that really starts driving that private investment. We will start seeing consumers get a much more positive view, and that sentiment is an important one. As that happens, companies should start investing more. We're already starting to think about how do we create the supply for this, because we will need to ensure that the supply is there for that demand. And that, in effect, would be one that really starts driving private investment, which has been an important factor that's been missing so far.
Anish, is there any way, and I'm not talking for specific numbers here, but is there any way for you to give us a sense of the multiplier effect of this on, say, auto volumes? And if you can talk about Mahindra and Mahindra, the leg up, as Rajesh said, every part of our portfolio will get a leg up, pretty much. So in terms of volumes and the bump the volumes get because of this, in the ballpark, what's your sense?
Prashant, a little early to say that at this point. We've also been in a situation where we've been growing mid to high teens from an SUV standpoint, while the industry has been very sluggish. And for us, it's a product set that has enabled that to happen. So we will see a further growth rate increase, but the extent of impact is something that we will have to wait and see as to what the level of elasticity is to prices and how significant that will be. But again, from where we sit right now, we expect this to be a significant boost.
All right. Just one more question I had, gentlemen, because I want to ask about how the tractor inverted duty changes. The reason I ask this is because the GST is reduced for tractor, but the input of steel, there the duty is largely unchanged. So how do you manage this?
There are, Nigel, I haven't gone through all the parts, but we have seen a list of parts. So the government has tried to work on the inverted duty structure for tractors. And there are a list of parts which are tractor specific, which have been called out, which will be at lower duties. So, but I need to go through that full list to see what percentage of the input credit it impacts. It does lead to some kind of a working capital blockage, but that's insignificant in the context of the overall upside that will come out of this pricing boost.
Got it.
Mr. Shah, sir, finally, going back to the overall point, to what extent, I mean, how should we, interpret or imagine the sort of boost and, whether it's going to be a lasting boost to consumption and specifically to the auto sector that these cuts will yield? I mean, say, given your monthly run rate, of course, there'll be an immediate bump up, I guess, all the pent-up demand, maybe in the next 2-3 months, especially in the festive season. So by how much more than the average anticipation would you expect your volumes to go up? And then is it a one-time bump up? I mean, or how should we look at the longer-term impact of this?
So the basic impact will be is the fact that with prices coming down, demand should go up. In terms of specific numbers for us or for any particular company, it is going to be difficult to say, but it will be a longer-term impact. What I could say is, from a macro basis, I'd expect this to take our growth rate as an economy to greater than 8%, and for us to be somewhere between 8 and 10% over the next few years.
Okay, so so we're going to take that and pull that flash out that Mr. Shah thinks that the GST cuts can take India to 8% growth rate in terms of an economy. And again, Rajesh, if I could ask you the question, so if you were expecting X as your festive sales number, will it be X plus 20% now, X plus maybe 25, 30%, just so that we can wrap our heads around the size of the impact?
Yeah, you clearly don't give up, Surabhi. So.
Just trying.
I think, Surabhi, the reality, as Anish said, is there is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
All right. So glad that both of you could join us. Anish, thank you very much for being here on the channel, explaining the impact and what many believe is the one company which perhaps benefits the most within the auto space. Rajesh, glad you could make it. Thank you very much for joining us here on CNBC-TV18. Gentlemen, goodbye.
Bye. Thank you, everyone.
All right. Well, that's Mahindra & Mahindra with a rounded sort of perspective on the top-down and, of course, a bit about the bottom-up as well. So, and we'll, as I said, continue to get you reaction after reaction across sectors, cement, consumer durables, and so on and so forth. We'll take a quick commercial break here. As I said, with insurance, it's a little complicated, the exemption on policies, life, etc., health, etc., will that translate to premiums going down? The answer is not an easy yes. Niva Bupa Health joins us on the other side with exactly that. Stay tuned. Law.
Welcome back. Decoding the impact of all of those mega GST cuts. You just had heard a comprehensive conversation on autos. We'll get to insurance in just a bit. But in the meantime, let's also not forget there's a trading market and we have to look at what commodities have been doing as well. Manisha is joining in. Manisha, morning. What are your big headlines?
When it comes to GST, well, I was talking to cotton and textiles and agri, and input costs clearly have been rationalized as far as GST is concerned. So a big cheer coming in from there as well. But when you look at the international markets, where the headlines still coming in from gold now, where it is a fourth straight day where you have record high continuing in case of gold prices. $35, $70 an ounce has been broken now, and with that, we have seen the gold prices gain up by 37% in this year. Silver also continues to gain a new 14-year highs onto that one. And with that, silver is up 42% in this year as well. So very strong going when it comes to precious metal prices there. Markets are now looking at the soft U.S. jobs data, which is reinforcing expectation of a September rate cut. And if you look at the CME Fed tool, there is now a 98% chance of a 25 basis point rate cut in the month of September. In focus now is going to be the U.S. jobless claims, ADP employment, and then you have the most important Friday's non-farm payroll data coming in. So promises to be a very exciting next 48 hours in the international markets from here.
Okay, all right, Manisha, thank you very much for all the updates. As promised, let's now get to the insurance sector to understand what this means for companies and whether as consumers we indeed have something to cheer about or not, given that both life and health insurance policies have been moved to the exempt category. That's what the big announcement was. Also, GST on reinsurance cost has been moved to exempt. This confirms the CNBC-TV18 news break. We have Ankur Kharbanda, Executive Director at Niva Bupa, joining in. Thanks very much for being with us, Mr. Kharbanda. Now, this is the, just explain what your understanding is that now life and health policies, when we pay premium, it's at exempt. But the problem is, I think that, you don't get to claim input tax credit. So what happens? Will you have to adjust by actually hiking premiums? Will you look at absorbing it? Your first thoughts on this?
One is the customer will get this benefit. It's an 18%. It's almost 1/5 of the premium which customer was paying earlier. So he gets a big 18% adjustment over there. The second question, do we get the input credit? Because now it's into exempt mode. As of now, there is no big clarity, but assuming, we will get some more clarity after this. But we have three costs. One is reinsurance cost, then is our operating cost, commission cost. Reinsurance is also exempted. So hence some of our costs will get, there, which is waived. The rest two costs, which is the commissions cost or the other expenses, etc. cost, that is something which will not get the benefit out. And that's what we need to figure out, how do we manage this, because we want to give, the benefit to the customer. We want to give the full
if I can just make sure that we're clear, we're understanding this clearly. You're not looking to hike premiums. Whatever adjustments have to happen, whether it's with distribution costs, whether the company looks at it, the fact that reinsurance costs, that hit comes down, it'll not happen by a hike in policy premium. Is that right?
We're not looking at anything which is, giving on to the customer. We want to give this to benefit to the customer. We don't want to increase premium as of now. We still want to assess this, understand this in terms of what impact it has. But as I said that, this is an historic moment. We would see a lot of customers getting in. We would see a lot of...
Yeah, no, absolutely. Let me just ask you this. That's a very hesitant answer. You obviously would not want to hike premiums immediately. But does the math as it stands right now, do you need to compensate for the no input tax credit and the 0% on policies? Does the math necessitate a hike? Let me put it that way.
There are various factors we need to consider. Does it
just a short yes or a no, Ankur? I'm sorry to push you.
Immediately, no price increase.
Immediately, no price increase.
What is the definition of immediate, Ankur? Immediate is 1 month. 3 months.
We need to assess this. We need to get more clarity. But we want to pass on this to customers. This is an historic moment. We should celebrate this.
Absolutely. All right. Hi, Ankur. Good morning. Good to see you in. Let's focus on what we know then and what we can understand from what we have. Reinsurance cost, that will come under GST exempt category, as you mentioned, right?
Yes.
How much does reinsurance cost form of the total cost? And how much does commission and claim cost form? If you could break it up for us.
So it depends upon various policy sets. For individual policies, it's different, and corporate policies, it's different. And we have reinsurance treaties every year. It changes. But if I have to give you just a guess, overall estimate in terms of how much is the overall cost, all input cost, assuming if it's 1/3 is reinsurance cost, and the 2/3 is other cost. That's how we have divided this as of now. 2/3 is other cost, whereby we do not get the input credit today.
Do are health policies reinsured?
Yes, for us we do that. Do that. It's dependent on each individual organization.
But
how do they
typically,
want to do
compared
it.
to other segments, the rate of reinsurance in health is lower, as I understand it. Is that correct?
Lower. Yes, it's lower. Yeah.
Okay. So in that sense, I mean, that benefit also perhaps is a little lower.
Correct.
Yeah. I'm sensing a premium hike 3 months out, Ankur, if I can put it that way. But
I can't
as you
say
said,
that, but I can just say that we want to pass the whole of this to the customers.
The other thing, of course, you will because I pay 118. You collect 118 from me. You give 18 to the government, so I'll pay 100 now. So that is there. But the point is, on premiums, there will still be we'll see how it goes.
Overall growth will go up. My operational cost will go down because of that. So there'll be some benefits also coming from there. So we need to adjust all of this before we can.
Although I must say, health you'll take a health insurance policy. You don't wait for premiums up or down, right? It's a necessity. Those who want to.
Yeah.
So should this necessarily be a boost? It's great news.
It's a great news, yeah.
But it should not necessarily push up volumes or increase penetration in that sense, right? The cost aspect of it.
It will, not the cost perspective, but overall the business, the revenues will definitely go up because of this.
And also on that, Ankur, simple argument, but it just seems logical because if the price comes down by as much as 18%, I mean, if you pass on everything, then more inclination to move towards more premium policies, the more value-added plans, etc. So within the mix, what are the changes you'd expect? And therefore, what can be the business impact in Q3?
I sense at Niva Bupa that there'll be a lot of things. Senior citizens we saw that they were reducing sum insureds after some time. They would probably look at for a better cover and more sum insured. The young age, mid-age population who was seeing this as not a very important thing, a lot of new entrants will come. Tier 3, Tier 4, whereby it is not a priority today, health insurance, they will get into priority. A lot of value added, 60% plus of our cost is on outpatient. People were not buying health outpatient policies because there was an 18% tax on it. We see a lot of pull coming from the market on OPD as well, outpatient as well. So these are the few segments which we see will have a good uptake.
Yeah. Look forward to paying lesser premium on my renewal next time. All of us here, actually. all your customers, etc. as well. Thank you very much, Ankur, for joining us. And
Thank you.
We'll continue chatting, depending on, what happens at the ITC, because that, of course, is the thorn with regards to insurance. And, but for the customer, from a customer perspective, there is that 18% which goes away now. We'll take a quick commercial break here. We're going to come back. Deepan Mehta is going to be with us of Elixir Equities. He's going to tell us what to do in terms of stocks and what should do well on the back of what we've seen last night. Stay tuned.
Welcome back. Hope you're having a good morning. Well, it's good indeed because we have the GST rationalization that's going to be playing out in the month of September itself. And most of their questions have got answered late last night. Deepan Mehta, though, he's the man in the hot seat, Director of Elixir Equities, who joins us. Hi, Deepan. Near term, there could be some kind of skittishness with regard to demand. But in the longer run, this is going to be very, very good, right? Could you tell us, if you were to give us two stocks that would be the top beneficiaries going by what we have heard on the GST rationalization front? Could you name them?
Yeah, Nigel, good morning and thank you for having me on your show. I can name only one stock and you'll be surprised. That name is Bajaj Finance because it is all encompassing all the GST benefits which come through, whether it is appliances or whether it is automobiles. That is one company which clearly benefits from higher demand for its loan products because a lot of these items are bought on EMI, and that certainly is going to benefit the volume growth for Bajaj Finance. So it's the kind of the best way to play this GST cut is through a NBFC like Bajaj Finance, which is India's largest consumer finance company and a formidable player in vehicle finance as well. Having said that, it's a company which we and our clients are invested in, and so our views could be biased to that extent. And of course, the second company, if I had to name, has to be M&M. I heard the interview. The management is quite guarded, but I think that internally they may be rejoicing these cuts which have come because they are clear beneficiaries over there at a time when there's good momentum behind their products and the new offerings have been received so well. This clearly is going to be a boost for M&M and may lead to even higher market share for them. Maruti will benefit, but as I said earlier also, that the cut in EMI for small cars not material enough to really drive growth.
Yeah, no, absolutely. What else, Deepan? On insurance, what is your sense? I don't know if you heard the Niva Bupa management, right? As one of the newer ones, but what we're picking up is kind of a mixed bag. So it'll be a strange situation if you actually see some red on insurance names this morning as we open up. I don't know, but what your thoughts, Deepan?
No, Prashant, you're right. There's no confusion. Okay, whatever services they are taking, whether it is telecom services, internet services, commissions which they pay, a lot of other expenses except reinsurance they're going to pay GST on it. So effectively, I'm not sure how much of a reduction we will see in our premiums because initially I think they may bring it down to zero, but eventually when they recalibrate it, they may have to increase the insurance premium because all of these GST inputs will not be available and they will just lapse. So net you will see, of course, the reduction, but don't expect like from 18% to zero means an 18% reduction in the premiums in the longer run. So that's my view. Apart from that, I think one segment which needs attention here is also the apparel segment. And retailing companies like V2 and Vishal Mega Mart, to an extent even D-Mart, they also benefit because the GST has been cut from 12% to 5% for a lot of the items which are below 2,500. That even benefits footwear companies, low cost footwear companies like say a Bata or something. And that could also be a boost for demand at a time when the festive season is also looking very good. The marriage season is looking good. So this is an additional trigger for retailers which are in tier 2, tier 3. I think Trent also may be a beneficiary because of its low cost offerings. So that's also could be one of the stocks of sectors worth looking at and analyzing from a GST cut perspective.
Absolutely, yeah. I'm glad you put that on the radar as well. So, apparel below 2,500, footwear below 2,500, and V-Mart Retail, Vishal Mega Mart. I mean, these are the big names in that particular category at those price points. Deepan, just going back to autos for a bit, two-wheelers. Now, Bajaj, Hero, and Eicher. Let's take all of them very quickly. The biggest beneficiaries, I don't know, I mean, we know that Hero obviously is. Eicher, a small part of their portfolio is above 350cc. But from a stock positioning standpoint, and Bajaj Auto has been a big underperformer. So between the three, how would you spread your bets or place your bets? All three, 1, 2, 3, or none?
No, I think Hero MotoCorp, it's been an underperformer. And clearly, they benefit from the price-sensitive sector, entry-level consumer, commuter motorbikes. So I would go with them. Valuations also are reasonable. And I think if the export pick up for Hero MotoCorp, you could see it inching up as compared to its competitors or peer group as far as stock returns are concerned.
And what about the Royal Enfield? I'll tell you what, Deepa, and just to give you a live, real case incident, in 2008, I went to buy a bike. I went to buy that the normal standard, which was 85,000. I ended up buying the Machismo, which was 125,000 at that time. 2008, I'm talking about the 500cc. So for Royal Enfield fans, actually, it doesn't make much of a difference normally. But what is your take on it? The stock is not very cheap as well.
Nigel, every time we have the discussion on Eicher Motors, And this is what happens, I don't think this is a trigger for Eicher Motors, but I think the company is on a roll. Exports are doing well, domestic sales are doing well, the expansion of retail network benefiting the company. And I think high valuations clearly justified. You can see the monthly numbers also coming through, really well for that company. Having said that, it's a company in which we are certainly interested in as shareholders.
Yeah. Deepan, what we'll do is take a break here. We want to talk about one more name, right? Aptus Value Housing. And we'll get your reaction. You talked about, briefly mentioned financials as a space. So stay with us. We are back in just a bit. Okay, welcome back. 3 minutes to go for the pre-open session. We have Aptus Value Housing, which should be in focus as well. Nimesh is standing by to tell us the reason. Nimesh, tell us.
Hi, Prashant. So the block is done in the block window. So it's a clean-out trade. Westbridge has completely sold out. They've sold their entire 14.5% stake in Aptus Value today via block deal. The size was close to 2,600 crores. So, so a couple of things. One, there is no leakage because it's done in the block window. Two, the supply overhang would be out of the way now that because it's a clean-out trade from Westbridge. Again, I understand from a buyer's perspective, one large long-only fund was an anchor investor along with some domestic mutual funds. So disclosures will come in the evening, is my sense. But it's a done deal now, done in the pre-open itself. Westbridge has completely exited by selling its 14.5% stake in Aptus Value today.
Okay, so it's done, 2.5% higher. The pre-open will be with us in about 2 minutes and it'll give a sense of how things are starting. Nimesh, thank you very much. We'll get you some brokerage calls as well, which have come through in a bit from now. We're going to come back in just a bit from now with the technical trading ideas and also the management of Birla Corporation because cement is in focus as well. Stay tuned.
Welcome back. Well, we are at 9 o'clock, so we'll start getting the pre-open rates. And the first of them are coming through. So if you go by the sensex, and we'll wait for this to settle, the sensex is up 1% as of now. Nifty rates will come in just a bit as well. Let's wait for them to come in and settle down. Let's look at, of course, more reactions, more commentary that's been coming in on some of these landmark GST cuts. ITC Chairman Sanjeev Puri has said that the proposed GST cuts can provide good momentum to the economy. He also believes that the tax cuts can boost consumption, which has been lagging due to elevated costs.
This is a very bold step that the government has taken. It's the Honorable Prime Minister announced it on the Independence Day. And I think it's going to have multi-dimensional impact because it's not just about rate reduction. It is also about simplification. It is also about ease of doing business. So the changes are multidimensional and impacts are going to be even more profound. I think it's certainly going to make things cheaper for the common man. So it will fuel consumption. It will lead to a lot more formalization of the economy.
Okay, so more reactions pouring in from the leaders of India Inc. Let's get to our technical experts now and see how you need to navigate a big day like today. Sudarshan Sakhani and Mitesh Thakkar are with us. Gentlemen, good morning to both of you. So we're gearing up for this gap up open. The question is, what do you do from that point onwards? Mitesh, let me open with you. Index trades.
Good morning, Subhi. So I think, one we've been maintaining that the markets will possibly head towards the upper end of the range, given the fact that we were oversold on the PCI levels, plus we were near the 24,400 mark, which has been an important support area. I think the midpoint, comes around this 24,800, 850, and that is, we might just open above that. That should suggest some kind of continuation, and we might actually even test 25,000. In case we see further strength, then 25,150 is the upper end of the range. I think I'm even looking at a possibility of Nifty heading over there. So in the short term, the bias is very clearly positive. The worry in the entire pack was Bank Nifty in the last 2 days, but the Bank Nifty yesterday gave first signs of reversals. So getting past 54,200, and obviously that will happen in the opening itself, would suggest that the Bank Nifty could also head towards 55,000. So all in all, good chance that we might actually head towards 25,000 or even 25,150 in the next couple of days.
Okay. Sudarshan, morning. What would your approach be if we get this gap up as anticipated?
Yeah, good morning. See, there are two different trades. The first is for people who went and bought yesterday morning when that was a suggestion. For you, the trade is to take profits on half your positions and keep the other half. Just assume that you've bought it today, the other half. For those who don't have any positions, the trend is up. Look for a minor intraday dip and buy the Nifty. The chances are that we could, as Mitesh said, even I think we could reach 25,000 sooner or later.
And which is the better index to take that long trade, even if it's an intraday long trade, if you buy an intraday dip, which is the better index, Nifty or Bank Nifty, Sudarshan?
It would be the Nifty. It's much easier to predict and sort of decide on.
Okay. Mitesh, tell us if you concur, and of course, let's talk stocks as well. What's on your stock list?
On the stock side, I have all buy calls today. The first one is APL Apollo. Good crossovers on moving averages indicators suggesting upside. So buy here with the stop below 1652. Look for a first target of around 1720.25. Then a buy on Crompton. That's a stock which gave a breakout and then last 2 days has given a pullback. So gives a good entry point here. Buy with the stop below 328 for a target of around 345. A buy on Glenmark, which after good corrections, correction in the price is showing first sign of a reversal. So buy here with a stop below 1975 for targets of 2070. And Tata Steel, metals have been doing very well, and steel, the ferrous metal stocks have done extremely well. So Tata Steel made a fresh swing high, buy with a stop below 165 for a target of 175.
Okay, all right. Gentlemen, thank you very much, both of you.
Sudarshan.
Okay, Sudarshan is, apologies. Gentlemen, morning. Sudarshan, your picks, what would you trade?
Well, I'll do it quickly. Oil India is a buy with a stop under 394. BEL is a buying opportunity with a stop under 371. Siemens is a buy. 3147 is the stop loss, 3147. And I have a common name, Glenmark. Glenmark is a buying opportunity with a stop under 1967. Stay long.
Okay, all right. Thanks a lot for that, gentlemen. Well, there's a big boost coming in for cement. GST on cement has been reduced to around 18% from around 28%. To help us out with what's the impact on the sector as well as on the company, Mr. Sandeep joins us, the MD and CEO at Birla Corp. Hi, sir. Good morning. Thanks a lot for joining in. Well, GST rationalization has come about. The entire industry was talking about this for the last many years. Firstly, how much do prices come down by? Because all of it would likely be passed on. And what kind of impact can it have on demand?
See, first of all, prices will come down approximately, as they're saying, 10 rupees. So it would come down in that region, I would guess, 10 or so. That's how broadly, once it kicks in, that's after 22nd. But before that, one will have to see that you have to actually segregate between the short term and the long term. First of all, the next 2 weeks, I think it's going to be a slump. That's because, when the corrections are coming from 20th, trade down stocks, when you're seeing the prices going down. So September is not going to be such a good month for the industry, is my reckoning, both in terms of volumes as well as in terms of pricing. And thereafter, things will stabilize over there. And that will be, as you are saying, you'll probably see a correction of about 10 to 15 rupees, depending on the region, depending on how the balance is.
Okay, got it. So, but the broader view is that September could be a little bit softish, but because of this rationalization, it could spur demand. Earlier, you were talking about 7 to 8% demand growth. Do you think that's possible right now, taking into account that there's going to be some softness in the near term? And do you want to up that estimate?
See, first of all, it's too early to really make an prediction on the overall demand scenario. But I see the demand will get triggered not just by the correction of the cement duty. Where the monies will go into the hand of people is the all across reduction. So be it in consumer goods, be it in other building materials. A lot of other building materials, as you know, they have also, the duties have come down. So that will give more money in the hands of the home builders to go in for, and it should give a boost to the IHB segment. See, infrastructure demand would be by and large inelastic. I'm talking about the large infrastructure. Where you're going to see the difference is a lot of this will trigger the rural demand. It'll trigger the development expenditure in Pradhan Mantri Awas Yojana and those sort of projects. That'll take out. There you will see a positive impact. But the bulk of the impact will come, I think, from the retail sector. And that is where people like us who have a high volume of blended cement, high volume of what we call the trade sales, as opposed to non-trade, which is the industrial, the big infra sector, they are to benefit a lot.
All right. So a couple of aspects here. The street believes that maybe there could be some margin, gain as well, because maybe all of it or most of the pricing will be passed on, but operating leverage will help and focus on premium sales will help. And as you said, I think trade sales for you is around 70% of the mix. Is that correct? And out of trade sales, close to around 55-60% is premium. So do you think people will go in for higher amount of premium now, premium products?
See, premium, when you talk of, there are two ways to look at it. If you're looking at it from your market standpoint, you have to see the people who are operating at the higher price band. And there are people who are operating primarily on the higher price band. So if they have a strong brand pull, they have a pan-India presence, you will see some of the benefits coming in there. And for smaller players who have a mix of premium and what you call popular or the value segment, obviously they could see an uptrend on the premium, which has been generally, as you will see, a trend not only in cement, but in a whole host of industries. There is a premiumization going on. And if things become more affordable, you'll find especially the individual consumers who are now more aspirational, they are going to opt for the branded and the quality products.
Okay, all right. So there'll be some kind of downtick in terms of pricing. Demand for the year, you're working with high single digit, right? 7 to 8% cement demand growth.
We'll really get to see the demand post the festive season.
Okay.
Because there are various factors, it'll be too early to talk of. The monsoons has an impact. Some say the monsoon, the heavy rains could dampen a bit of the agricultural demand, etc. So I would not right now rush to predict a demand upsurge, but it'll sort of balance out between everything. As you said, if there is a price drop, there'll be certain benefits for price drop to people. It's not all because the coal, that's a big ticket, I think.
So just want to clear, sir, two more points. One is on SGST, because states effectively, now they'll get lower amount of money via the GST route. So will it hit incentives for a company like yours? Do you see it as a risk? Point number one. And the second point, sir, is on coal. Coal, the GST has been up to around 18%, but they're done away with cess. So effectively, that doesn't, increase cost for you. Could that be positive on the margin?
Coal would give people who are highly dependent on domestic coal, I think it'll give them a benefit because of the cess removal. That's the big thing. Because the other GST is going to get offset, that's an input credit, which you will get by and large. So that increase is not going to hit the bottom line straight away, but that cess reduction, especially for people or regions where people are dependent on domestic coal, I think that'll be a positive.
That'll be positive, but the state GST, could it be a risk?
State GST is slightly more complex. There are two parts to it. Those are capital, capex-based incentive. You may have a short-term thing, but the overall, the quantum of GST is not going to get affected as GST. And also, if there is a cap, most of the states have a cap, annual cap. So if people are already meeting that cap, it is not going to hit their absolute numbers in terms of number. In terms of the market, I think it should be healthy for the market because it will create a more level playing field. There are some players who were heavily dependent on incentive, and they will now have to be more prudent in how their pricing goes.
Got that. Thank you very much, sir. Thank you for joining us and running us through first thoughts as far as the GST cut is concerned. Let's get back to the market. 2 minutes to go for the market open. We're going to just revisit Mahindra and Eicher. Sur is putting the spotlight on these two names. Sur, over to you.
So two surprising factors in the auto pack from the GST Council meeting. One on the positive side is for Mahindra and Mahindra because now SUV GST has moved higher to 40%, but effective tax rate would be lower than the earlier tax rate because earlier, for example, on XUV 700, 28% plus 22% cess, so total effective tax rate used to be around 50%, which would be now at 40%. And now management is saying that 60% of companies' total volumes, including CVs, will be in 18% slab, and 40% of SUV portfolio will be in 18%, and rest will be in 40%. So overall, it's positive for M&M. Second, Eicher Motor. So almost 89% of its total volumes will be in 18% category. So that's positive. But one surprising negative factor is almost 10% of total volumes will fall into the bracket of 40%. So effective tax rate will increase from 31% to 40%. So that would be minor negative for Eicher.
All right. We got, things opening up. Eicher is up 5%, as you can see. If we have time, let's just quickly put the stocks up. I don't think we'll have enough time. But
M&M 7%.
Yeah. So, and by the way, the Nifty Auto Index, I just looked, from 14th of August close, 15th was the Prime Minister's announcement that we'll go big on GST. It's up 7%. But even after that, you got big opening gains coming through. 24,900 on the Nifty, 81,250 on the sensex. And these are the first rates which are coming through. 190 points, almost 200 by the way. 24,900 is coming through on the Nifty at this point in time. The Nifty Bank is up about 0.5%, 54,318. And the mid-cap index is up about 1%. The small-cap index will come up on your screen, which should be higher as well. So across the board, of course, it's green. And I think all 50 Nifty stocks should be higher, maybe the insurance names, but we'll see. The heat map should tell us that. We'll dive into individual stocks, sectors, etc. Right after that. The reinsurers, etc. are opening higher. Heat map on your screen. What do we have? Okay, not all. IT services and a bunch of others are lower, but otherwise it's all up. And Mahindra, I think, is leading the way once again. 160 points on the Nifty. Surabhi.
Absolutely. And M&M is looking really, really smart with a gain of almost 6%. But I must point out that even insurance, where there's the worry, right now, all insurance stocks have opened positive, including Niva Bupa. Niva Bupa is surging 7%, might I add. The company just told us that overall it's going to be very positive. They will be passing it on to the customers, at least as of now. And they expect perhaps higher value policies and a bigger sum assured to get sold because people have more money to just buy better and bigger policies. And that seems to be working in favor of the stocks. Anyway, coming back to the Nifty tally, apart from the individual beneficiaries like a Nestle, like a Lever, like an ITC or a Hero Moto, look at Bajaj Finance. The market is choosing to play this through some of the diversified financials. And we know Bajaj Finance obviously has a huge consumer lending franchise. And that stock is the next biggest beneficiary after Mahindra and Mahindra. Then come in some of the big cement names like Ultratech Cement. Nigel's been telling us that overall it's a big positive as well, with the cement moving to 18%. Eicher Motors, Nestle, Lever, ITC, Trent. Incremental gains between 1 and 2% on all of these stocks. And even the insurers within the Nifty, SBI Life is positive, HDFC Life is up 0.5%. So there is no big slam dunk on insurance at all. Perhaps the market had enough time to prepare for this. On the flip side, actually not too much. Reliance is a bit of a drag. It's a bit of a spoil sport this morning, down about 0.5%. Eternal is cooling off. And some of the metal names after yesterday's scintillating performance. Today, the metal stocks, Hindalco, Tata Steel, etc., they're slightly lower. From a 200-point pop, now we're looking at a 160-point move on the Nifty.
Well, some of those hotels as well are doing well. Lemon Tree, that's moving on high volumes, up 3.5%. As Deepan said, Bajaj Finance, well, that could be the ultimate beneficiary because all the items that you're buying, by taking some credit, well, their GST has come down. So that could be an indirect play. And that's why that stock is up close to around 4%. Solid move on that particular name. Dabur is up close to around 4.5%. So big move out there. Vishal Mega Mart is another stock that's moving on very, very large volume. So that one's up and about. The ones that are under pressure, you have Delta because the casino entry GST rate has been fixed at around 40%. And Varun Beverages as well. That one is down close to around 2.5% or thereabouts. Ashok Leyland actually is down close to around 2%. That's one of the notable names from the auto pack that's actually underperforming in today's trading session. Pull up Newland Laboratories as well. There was an IC note that had come in from Nuvama with a target price of around 17,700, I think so. So maybe we could get that stock up for the time being, it's up only around 0.5% or thereabouts. But otherwise, autos, consumption themes doing well. The market's holding at around 24,850. You'll want to hold on to these gains. The markets are net short. It could result in a bigger up move, but you need to hold on to these gains.
Well, that's the thing, right? 180 now, 150 actually. So just about getting things going this morning. We'll get to individual stocks and talk more about this, but let's welcome in Venugopal Gare as well. He's India Head of Research at Bernstein. Venu, good morning. Great to have you with us here. Thanks very much for joining us. Venu, the simple question is, how much is in the price and how much is not across sectors, across mostly consumption sectors? Rates are either flat or they're lower across the board. How do you think about this question? How much will this do to increased affordability as a fillip to consumption? Venu, go on.
Yeah, thanks, Prashant. Everything in life is relative to what it was earlier. So that's a broader principle I use. So if you were to look at consumption in general across the board from a broad-based standpoint, from an economic data points perspective, things have not been that great in the last couple of years, while we've essentially seen the other parts of the economy, including industrials, capital expenditure, essentially being the ones which have led the last few years. Now, what is essentially happening is broadly a forced policy push towards consumption. And this is not the first point at which this is being pushed. We've been sort of seeing the change in theme from the fag end of last year with the direct tax cuts announced with effect from April, a $15 billion sort of a positive cash flow to the middle class, which is a recurring annual sort of a cash flow. And on top of that, you have this GST impact, which purely from product standpoint, when we look at the impact is more than $20 billion. I'm just ignoring anything on the services side, which again is a pretty large number. Remember, that doesn't stop at this. We also have pay commission impact, which is a pretty large number again next year. Lower inflation this year in the second half of the year, lower rates, higher liquidity in the system. All of it broadly needs to be factored in when it comes to the potential positivity when it comes to consumption relative to every other sector. So that's the way I would look at it. At the margin, incrementally, the sector would outperform. Quantum-wise, of course, remember that the limitations, if at all, would be the fact that economy in general hasn't been that great. And plus, you have the export impact, which might sort of impact a bit of jobs here and there. We need to negate that as well. So these are the counterbalancing sort of aspects to the extent to which you will see a push.
By the way, I just want to point out that the market today, today's level of the Nifty is a couple of notches lower than where the market closed on the 18th of August. And why do I talk about 18th of August? Because that's when the market reacted to the announcement, Prime Minister's announcement, which was made on the 15th of August. The market that day closed at 24,876, exact number on the Nifty, 876. Today we're at 852. And Venu, that's my question. So much positivity has been thrown at the market. This big, government spent a lakh crore, right? That's the revenue loss from these GST cuts. And there's hope of a good festive season, good monsoons. But why is the market in such a funk? It's simply sort of refusing to see or get too excited about the positives. So what do you think this is? Is it just because of the extent of selling? Or what's happening here? Why not the kind of excitement that you would anticipate after a move as big as this one?
The way I would look at it is that the economy has not been very strong for almost a year. Ignore the base effect aberrations and catch-ups, which led to a recovery in the March and June quarters. But on a broad basis, domestic economy has been weak. The second main part is, of course, you're still seeing some concerns on the geopolitical side of things, the overtures India is trying to do with China, US-India relationship spoiling. We've essentially moved to a 50% tariff. After the GST announcement, 2 weeks later, we had moved into that higher tariff rate. So putting all this into perspective, remember that a lot of what is essentially happening on the policy front are offsets to economic weakness. And of course, what we are seeing today is slightly larger than an offset, but the reality is it's only neutralizing some bit of the negative impacts. The other thing, remember, is purely from a flow perspective, there are two main things to note. One is we've not essentially seen EM money or FII money essentially too excited about India. Part of that is because there were great opportunities elsewhere. And more importantly, economically, things were a bit more weaker, along with valuations being higher. So that is something which needs to reverse in the second half of this year for you to see markets to go to higher levels. And we do believe later in the year it would, because once all these moves essentially lead to an improvement in the economy is when you essentially see FII money flow in. And whatever domestic money is flowing in, you're also seeing the IPO pipeline as well accelerate. So there's a lot of selling as well happening in both the primary and secondary markets, which is sort of digesting that bit of a flow. So it's a combination of all that. I wouldn't really worry too much about it 6 months from now, but don't expect any immediate gains just because of this move.
Hi, Venu. Good to see you, Ben. But it's encouraging to see at least the center taking note of the slowdown and acting on it. And monetary policy as well has been pro-growth. So I think both those two at least, they acknowledge the problem and trying to do something about it. That said, the two big beneficiaries, going by the reactions on the stocks, going by what most brokerages are saying as well, autos as well as FMCG. Now, FMCG actually, the staples part of it has underperformed. How do you approach that pack? What do you like from FMCG, the discretionary spend, or do you think staples as well, you'll give it a look? And from autos, which category do you like?
Okay, so, on an overarching basis, when we headed into this year, we had a change of view in terms of how we positioned our sectors. So this was the first ever year where we had consumption overweight on a broader basis relative to industrials. Now, within consumption, FMCG as a space, I had upgraded about, I would probably say 1.5 to 2 months back. And that is a sector which is essentially underperformed for a fair bit of time because of volume growth concerns. This is a space, I guess, given what has happened to GST changes today, is a positive surprise, honestly. I didn't really expect some of those categories to move to 5% rate, especially when things like shampoo, soaps, I thought probably it'll be still at 18. So it is a positive surprise. So FMCG pack in general, I guess, still has some legs because it's not really done well in the last couple of years. Within the small value discretionary, I think we shouldn't miss out on that fact, which is durables and other areas, ideally should also see some degree of lift in terms of demand. Remember that just because a consumer is saving, let's assume the $20 billion number based on whatever he was purchasing earlier, that money doesn't need to go into the same sector. That could perhaps be used for buying any other product, or maybe even invest or repay debt, whatever. I mean, from a quantum standpoint, one can discuss. So that is a very important factor as well when it comes to taking an overarching view on consumption rather than a particular category. Yeah. Coming to autos, very clearly, it's a benefit across the board for ICE players versus EV, because the gap between EV and ICE tax rates are narrowing. And within IC, we've been in general positive on small cars, which has essentially seen a run. We're also positive on the tractor sort of / SUV space. So these are relatively more preferred rather than an entry level motorcycle, because we do believe that wherever penetrations are lower, there'll be a larger propensity to see a broader volume impact, as against sectors where penetration is already high. You should ideally see a lower impact in terms of volumes. So that's a broad way I would put it.
I just want to quickly highlight that if you look at the auto space, right, it is Mahindra, at one level, everything else is far below. Eicher is also just up about 2.5%. Mahindra continues with its 7% pop, not very much else really in a big way, which is sort of starting to show through.
And on auto, the actual beneficiaries or the ones that were supposed to be big beneficiaries like Maruti or Hyundai, the stocks have also not moved too much. Those stocks are up between 1.5%.
So it's a sad thing, but as someone said, and I think it makes sense, right? That like at the lower end of the EMI difference, for example, a Alto or the entry-level kind of cars, the EMI difference is so small, it's actually a few hundred rupees on a typical auto loan. So if you could not afford a EMI, for the entry-level car before, would a few $100 make a difference to push demand?
Yeah.
Right? That's the. I think it's a relevant question to ask. Hopefully it does, but I don't know. Yeah.
No, absolutely. And in fact, I was going to ask Venu exactly about this, about financials and the way we need to think about it. Because, of course, Bajaj Finance is a clear beneficiary straight out. But overall, on financials, would you expect...
I think Venu wants to say... Venu, you want to add something? I can sense that you want to come in. Go on, Venu.
I just loved your comment on the quantum of EMI impact. If you were to extrapolate this to every product category, then there's going to be zero impact on anything. So a 20 rupees soap, why should somebody buy? Because it's 2 rupees cheaper, right? So I think we need to look at it from a broader context of...
No, you're agreeing with me, or you're being sarcastic, Venu?
I'm being sarcastic with you, not to the market.
Sorry, what is that?
I'm being sarcastic on your comment rather than on the market and the benefit. I do believe you need to think of need to look at things from a very holistic overall impact perspective, right? So this $20 billion number is, I don't want to nitpick on particular categories. Honestly, 100 to 200 rupees saving is very meaningful for a particular individual who's buying a two-wheeler. A 5 rupee saving might be quite meaningless across the board on a soap for anyone, right? So, but the saving is a saving, right? And it's going to feature somewhere in terms of some incremental volumes. That's the way I would probably present it. And also remember, Prashant, that Maruti...
No, Venu, my point, the point is, you're aggregating all the savings, and that is saving in the hands. It'll go somewhere. But my only point was, can you say this segment is where it's going to see a bump up? I mean, that was my point. So for entry-level cars, will demand go up significantly because you got a couple of hundred rupees in terms of EMI savings?
But the price of the car
I'm not sure.
itself is down 10%, right? We have to take that on board as well. That the price itself, if it's passed on entirely, like M&M said, the price of the product does go down by 10%.
That's what I'm saying. Yeah. But calculated as EMI.
As EMI.
It's 700-800 rupees.
Yeah.
That is my point. I'm saying, will it really move the needle for that product category? I'm not sure. Go on.
Prashant, fair point. In fact, just a couple of minutes back, I had commented this, right? Saying that a saving in a particular category does not mean you invest in a particular category.
Exactly.
You would probably invest in saving somewhere else, in any other category.
Yeah. That I agree. completely. Yes. No, I think we're
also remember that stock prices have moved very differently. Maruti had moved ahead of this particular announcement quite materially. It was below 12,000 rupees just about a month back.
That is true.
So
that is true.
Think of that fatigue as well, right? And
no, absolutely.
Had not moved much 2 weeks into that previous GST announcement after the Independence Day. So maybe that is the other aspect to look at it. Plus, this incremental thing is tractors also have happened. So that is also playing more as a positive sort of a spirit.
No, absolutely. And everything doesn't need to happen on day one. When you take that point, I mean, the manufacturers themselves have told us, right? This will eventually play out. They'll ramp up their production and they'll see what the debate that you and Prashant are having, I think we'll have exact clear answers within 2-3 months on whether the customer behavior starts changing, because the headline number of that particular vehicle itself is down by 10%. But I just want to get back to the point on financials. Whether we should look at beyond something like a Bajaj Finance, whether we should look at banks differently. Do you expect a leg up in financing to show up? And if yes, across what kind of lenders?
Yeah, I mean, honestly, the financial sector is in a situation where credit growth has been fairly weak. In fact, deteriorated all through the beginning of this year. As you see the second half of the year, there are clear positive signs of why credit growth should improve. We're essentially seeing a lot of liquidity come in the system. And more importantly, I think the regulatory system is more or less keen on pushing up consumption leverage back again a bit at least, or leverage in the economy a bit more, right? So these are all positive signs. You want to play it through a bank, you want to play it through a pure play durable lender, or you want to play it through let's say even things like affordable housing companies. It's across the board. You could pick and choose where you're more comfortable from a valuation standpoint. See, I'm on an overarching basis overweight in financials, apart from my consumption overweight here and there. And as you know, I'm underweight industrials and other areas. So I would be probably playing a bit of financials as well from a standpoint of leverage.
And which category? I mean, spell it out. You just named a couple of them, right? But where is it likely to show up the most? Specific niche NBFCs catering to consumer housing. Where would you really expect the impact to be?
Exactly. The consumer parts of each of these entities. Some companies would be more, NBFCs would be a bit more leveraged to that. So they'll probably benefit a bit more than an overarching large bank, which is doing a lot of other things. But then my call in financials is not purely linked to GST and consumption. It's more led with overall credit growth improving from where we were earlier. So it's tough for me to, remove myself from that broader thought process of overall credit growth and not just consumption-led credit growth.
So financials, right, where the financials are lenders, they're economy-facing, and so you don't have to choose. I don't know, you can't pick stocks, but I'm saying something like Bajaj Finance, right, consumer lender. I'm assuming with exposure to multiple sectors, but on the consumption side. So it should show up in those kind of names.
Yeah, I mean, look, it's all about relative growth as well, Prashant. So if something is growing 25, it goes to 27, does it really lead to much impact versus something growing at 8-10% credit growth going to becoming 12? I guess the impact is much more for that, right? So you can't basically take a particular stock and say the impact is only going to be on them.
You're being very cryptic today. We'll need to.
I wanted to avoid
You're saying this and that. But anyway, we'll leave it there and we'll talk again and come back and we'll talk again. We've got lots of GST companies to talk to as well. Appreciate your time here as always, Venu. And thanks very much for joining us as always. So that's Venugopal Garre, Bernstein, with his perspective. We spoke with the top management of Mahindra and Mahindra. That by far is the biggest gainer on the Nifty. Anisha, Rajesh Jejurikar. Listen to what they told us. Basically, every part of the portfolio, according to the Mahindra management, will get a leg up. Listen.
Ushers in a new era of simplification and possibly a new era of ease of doing business as well. It will have a very significant impact on consumption. And this is something that should, in some ways, create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way.
Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. There is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
Okay, that's a take from Mahindra, and Mahindra stock is still looking rock steady and solid, 6.5% higher. Overall, the Nifty, it dipped to about the gain being a 150-point gain, but now again, you're seeing a second wave of buying come in, and overall, it's looking really good. A lot of consumer stocks, by the way, Nestle, there is ITC, there is Lever, there is Trend, plenty of names. Actually, let's look at some of the others as well, like Dabur. Yeah, Dabur's up 3.5%. So many consumer names on the upswing. Colgate 4%, and I named some of the others as well. In fact, on that note, let's bring Mangalam back in to look at specifically ITC to understand, because it has lots of different parts of the business. For some, obviously, the rate goes down, but what happens with tobacco? So overall, what does this mean for ITC? Mangalam?
Well, from all the details that we have so far, it looks like it is a positive for ITC, and here's the reason why. Because if you look at the current cess and situation or taxes on tobacco itself, it is 28% GST, plus there is a specific and ad valorem cess, which totally amounts to about 53 to 55% of the MRP of a cigarette that one buys from the street. What is proposed that this compensation cess will actually be subsumed. This 28% turns 40%, and GST will be 40%, which will be charged on MRP versus the transaction value, versus what it is right now, 53 to 55%. The government has said it will be tax neutral. So what this means is that we need to know whether the NCCD or the National Calamity Contingent Duty continues or not. If that does continue to the rate of around 10 to 15%, that means it is absolutely tax neutral. And that is what the analysts are expecting. So no increase is definitely a positive. The second part is that a large part of their other portfolio, non-tobacco portfolio, FMCG staples products, they've been bought under the 5% slab. So that's positive for the volumes out there. And then they also get a fair amount of revenue from notebooks, the ITC classmate business, and that the exercise books, notebooks, etc. have been brought down from the 12% slab to nil. So the tobacco portfolio, there is no fear of increased taxes, and the other portfolios, there are lower taxes. So all these, with the fact that the stock is trading at around 25, 26 times 2-year forward earnings, makes it stand out in terms of beneficiaries from the GST rate rationalization.
Okay, all right. So ITC climbing on the back of all of that put together. So net, nothing negative. And in fact, incrementally for some of its businesses, including FMCG, notebooks, etc., there are incremental positives coming through. However, AC stocks are actually, slightly under the weather, can I say, because there's not much of a euphoria. Voltas is down about 0.7%. Blue Star is up about 0.3%. Though, of course, there has been there's been a build-up. So if you look at a longer-term chart, let's pull up Blue Star, and if you see, say, 6-month chart or a 1-month chart, this week itself, going into the GST meeting, there was a little bit of a, so there was a bit of a pop that showed up. The question is, what happens from now? Because the GST cut has indeed come through from 28%, ACs, washing machine, a whole range of consumer durables, television sets, everything has moved to 18%. So let's discuss this. We have Mr. B. Thiagarajan, Managing Director at Blue Star, with us. Mr. Thiagarajan, thank you so much for joining in. Now, very interesting, right? I remember all our conversations. It was a rough start to the year with a washout, monsoon season, tough first quarter. But now you've got a big bonanza coming in from the GST Council. So help us understand this, sir. I mean, but, ACs are also, it is also a seasonal business to a large extent. What is the immediate implication? Do you expect any sales in the festive season? Because some parts of the country, including here in Mumbai, October can be fairly warm. So, what is the impact near term and then medium term?
Good morning, Shirbi. It is a pleasure interacting with you. So as we had discussed, the summer season was bad. But whenever summer season is bad, the festival season always does well because of the latent demand. So one would have anticipated 15 to 20% growth during the festival season. But when the announcement was made on August 15th, as you can imagine, the consumers would wait, and they have been waiting. I think they will wait till September 22nd. Rightfully so, they are entitled to this benefit. So I anticipate that from September 22nd onwards, till the new year, it should be a great season ahead for multiple reasons. Significant reduction of around 10%. It is anywhere between 2,500 to 3,500 rupees, depending on the model one wants to buy. And never in the history there had been such an increase through one announcement. There is a energy label change that is coming up on 1st January 2026. Therefore, there will be a rush to purchase the products before the prices go up. And the third part is that there will be significant amount of shift in the consumer behavior. Someone who wanted to buy a 3-star will end up buying a 5-star. Someone who wanted to buy one air conditioner may even consider buying 2. So therefore, this is a period. You see, also I must tell you, the disposable income is going up on number of friends actually.
Oh, absolutely, absolutely, because there are savings across the board. Depending on apparel, etc. So we'll need to see where the consumer really decides to spend more, and it might be different for different categories. But sir, you said that earlier you were working with a growth of 15 to 20% this festive season. Now with the cuts coming through September 22 onwards, what is your estimate for festive season? Could it be higher? Could it be 25 to 30%?
It should be higher, but not in Q2, but if you take Q3 together. See, I will also tell you, we had shared the figure that even though the summer season was washed out, the year began with an expectation 25 to 30% growth in FY26 is possible.
Yes.
But when the summer season had been a washout, we felt that 10 to 15% growth only is possible. Now I would say the industry can look forward to even 20% growth for the full year. And it is indeed possible, even though the summer season was a washout.
And how much in the festive season, which largely is going to, fall in end September Q3, but again, festive to festive comparison. Earlier, you were expecting 15%, 15 to 20%. What's your expectation now?
I think it will be 30.
30%.
Generally in India, when an announcement is made like this, there is a huge rush. And this will indeed be taking place. And the intention here is to pass on the full benefit to the consumers, right? And that's what we will do.
All right. Hi, Mr. Thiagarajan. Clearly, you're sounding quite optimistic about how things will pan out from here on. But I just want to ask you how the 20% GST in the current inventory will adjust itself?
Nigel, an intelligent question. So there are products which the dealers have bought at 28%.
Yeah.
If the rate would have remained unaltered, there is no issue. But here he will have a higher input tax credit. It is not only air conditioner, the GST rate has dropped across consumer durables. So therefore, the dealers will have a working capital burden. We have done the calculation, possibly for about 2 to 3 months they may have the burden. And there is some compensation that may have to be considered in terms of that interest burden they have.
So then near term, it will be a bit of an issue for those that are already sitting on that inventory, right?
In our case, it is around 30 days more than what is required. That is the inventory. But that's manageable. See, nothing in life comes without going through some hardship, right? But I'll tell you one more thing. The entire portfolio, the demand planning will change, right? We would have planned for certain quantities in October, November, December. We have to wait and watch and produce more. The next part is connected with there will be a significant shift. A person wanting to buy a 2-star will end up buying 3-star. Yeah, some other brand someone want to buy may buy a premium brand. And a 3-star buyer may ask for a 5-star. So there is going to be some work to be done in order to reap the full benefit of this reform.
Okay, got that. We'll leave it there, sir. Thank you very much for joining us. It's a pleasure. And very sort of good insights in terms of how this may play out for the AC sector. So there's a clear bump. There could be upgradation in terms of aspirations of what people want to buy, the kind of ACs, the number of ACs, etc. on the back of this. We'll take a quick commercial break here. We'll be joined by the managements of Poly Medicure and Metropolis Healthcare on the other side. We'll talk about, of course, the impact of GST. Poly Medicure, of course, has also made an acquisition, so there is that as well. Coming up.
Welcome back. Well, GST on medicines have been cut from 5 to 5% from around 12%. In fact, GST is reduced to 5% from 12% for diagnostic kits, blood glucose monitors, various devices, bandages as well. We're now joined by Himanshu Baid, the Managing Director at Poly Medicure, as well as Ameera Shah, Executive Chairperson at Metropolis. Hi, ladies and gentlemen. Good morning. Thanks a lot for joining in. Well, Mr. Baid, coming across to you first, you've also done an acquisition. We'll talk about that in just a bit. But, duties coming down should spell good times for your business. I think a third of your business comes in from India. So tell us your reading, what kind of a positive impact it could have?
I think, we have 3 different structures, 5%, 12% and 18%. Everything gets collapsed to 5%.
So I think this will spur demand, especially for essential healthcare products, so especially used in home care area like thermometers and glucometers and all that. And on for hospitals, the cost for medical devices will come down from, let's say, because of reduction in GST. And as they are nil rated, so they don't get any benefit for higher GST rates. So as the GST comes down, I think the cost of treatments for patients will also come down. So it's very, very positive for the industry.
Okay, all right, got that. We'll try to get some numbers out of you, Himanshu, in just a bit. But Ameera, coming across to you, diagnostic companies, well, they should benefit because of lower capital cost and lower raw material cost as well. Do you believe it's a possibility you could quantify it, in terms of basis points, the outlook on the whole?
See, this is a landmark reform that the government has done, and frankly, at Nat Health and obviously from all of us, we've been pleading with the government for a long time, saying because we don't charge GST to the consumer, we have all these input costs with no actual offset. So this actually gives an opportunity now to to be able to have a lower GST input cost. Because medtech has come down and reagents and chemicals, the GST has come down from 18 to 5. That will certainly expand access for the industry. It will create a fairer competition playing field between the unorganized and the organized. And also, as Himanshu mentioned, the rates were all across the board earlier. I think that will definitely aid in ease of doing business because you have now one GST slab versus multiple. And the biggest one, I think, which is the most beneficial for consumers, is that with insurance, GST coming down from 18 to 5, as well as from, like you said, glucometers and other areas, this actually is a direct benefit to customers, right? It significantly makes it cheaper for them. And I think it'll really expand access to health insurance through this.
Ameera, on diagnostics, will we see price cuts, price reductions for consumers on tests, etc.?
It's difficult to tell because diagnostics has already been obviously a very, very competitive pricing already because of competition. You have to remember that GST was not really applicable to the consumer at all. It's only on the input cost, and that also not everybody in the industry has actually been bearing it. So actually, more than anything else, it will create a little bit more of a fairer platform for people. And hopefully it will create a better sustainable healthcare ecosystem where you can make more investment in the industry.
But Ameera, just to understand now, for any diagnostics lab, whether it's surgical equipment, gloves, consumables, I think bandages also. So on a lot of these items, testing kits, and on a lot of these items, the GST gets lowered. But as customers, we don't pay individually for these items. We just pay for the cost of the test. So how will the benefit be passed on to the customer?
Like I said, it's difficult to tell at this point of time. Like I said, there's two different separate, right? On the retail insurance and on the glucometers, there's a direct benefit to the consumer, right? Because the consumer was paying 18%, now it's 5%, there's a direct benefit. In this case, it all depends on whether the hospitals or the buyers of these reagents and chemicals are able to see benefit in their P&Ls and are therefore able to pass on part of it. You have to remember that the organized sector or the ethical organized sector, which was actually paying GST, was making significantly lower margins than obviously the sector that was just not paying GST at all, which was actually majority of the sector. So this actually creates more of now a level playing field versus anything else. So whether or not you're going to land up seeing a big, dip in prices is very difficult to tell at this point.
So if there is no dip in prices across diagnostic chains, then there should be a margin improvement. Either one has to happen.
You're right. Either one has.
Yeah. So should we expect better margins for Metropolis or for the overall industry if there is no cut in pricing for tests?
It really is too difficult to tell at this point because I think the news has just come out. I think everybody will have to go back to their companies and really look at what is going to be the impact for them and what is going to be there for a potential benefit that could be created for the consumer or whether it's going to be a margin expansion. I think it's, I think the next 15, 20 days, everyone will do their own analysis and make their own courses.
Okay, all right. Let's come back to you, Mr. Baid. Then you have done an acquisition in Europe as well. You've done it at roughly EV upon sales, I think it's around 2 times. What's the plan with regard to this acquired business? It was doing around 10 million euros last year and I think around 1.5 million euros of EBITDA. How do you see this business scaling up?
See, Nigel, if you remember, we started our cardiology business just a few months ago. And to scale up globally, this was the best option for us because this company has all the regulatory approvals needed to sell products in Europe and also it has a US FDA approval. So this gives us a leverage to enter the European market very quickly with our products. And also we'll be able to, get synergies and cost savings and R&D benefits across both the companies. So this company is also, doing R&D on some cutting edge technology, and some products are going to be launched in future also. So all in all, I think it gives us a huge strength in the cardiology business going forward. And we are looking at it as a strategic asset. And again, there are a lot of synergies in distribution network. We can leverage our network, global network. We can leverage their network, and there are a lot of partnerships coming with this acquisition. So this will help a lot in the long way.
Sorry, what does this, Himanshu, what does this allow you to do? Pendra Care Group?
See, they are in interventional cardiology there. So basically, guiding catheters, diagnostic catheters, using angiography, angioplasty. So these are products we have just recently launched in India. So we get a, full, range of products which is already established in Europe. So we don't have to go through clinical trials. Or if we had to go through, we would have waited 3-4 years for this. But now we have a direct access into the market immediately with these products, and we can help them to reduce costs also. And help up improving the margins. And also whatever we are developing in India, this will become our let's say, our springboard for the European market.
It's doing margins of around 15% right now. You do higher margins. So do you see in the next 2-3 years, you're trying to bring this acquired unit, at par with what you are doing currently? Yeah, and from around this 10 million euros, where do you see it headed? What kind of pace of growth?
So we are looking, Nigel, when the synergies kick in, we are looking at margin improvement, maybe 2 to 3 million euros of, let's say synergies coming through margin improvements across both the companies. And then if you look at the growth rate, let's say by 2030, we should look at, a growth rate, number close to around 25 million euros for this company in terms of revenue. So maybe a CAGR of 23 to 25%.
Okay, well, those are good numbers, which I think we'll watch out for. Himanshu and Ameera, thank you both for joining us. Really great to get those insights from the both of you at this point in time. So that's, medical equipment business and, of course, healthcare on the diagnostic side, getting you a sense of what's happening. 200 points, by the way, on the Nifty. We're at about 24,915. I think we should just look at what's happening in the market in terms of stocks, etc. as well. I think right up. We were talking about Bajaj Finance with Venu earlier. Bajaj Finance is the top financial gainer, 5%, completely consumer-facing. It's up $40 on very large volumes. And Mahindra continues to be the top gainer across the board. It's actually M&M and Bajaj on the NSE, number 1, number 2 volume-led gains. Escorts is not doing badly at all, almost 7% at the number 3 spot. And they've got a bunch of these... FMCG names. Britannia I can spot, Colgate I can spot, those are the others. Bata is up 6%, Bata India. So 1,230 coming through on Bata. Campus Footwear is up about 5.5%. We'll try and speak with some of these footwear companies on the GST impact as they see it as we go along. PG Electroplus, we just spoke with Blue Star. PG, of course, it had that big issue. And with regards to guidance, etc., they were talking about the huge inventory, industry and PG-specific inventory in the system. They said, well, it'll clear out in the normal rate only by about November, December, late this year. Maybe this helps in clearing out the inventory faster, but they'll, of course, take a hit on some of this inventory because it's priced higher, taxed higher. Godfrey Phillips is up 5%. Right now. And one name from yesterday, right? NetWeb was limit up yesterday. It's up another 6.5% at this point. So, there is a lot which is going on with regards to this. Actually, the other one is E2E, similar kind of space, 4.5%. E2E was also limit up, circuit up yesterday. So gains are showing up here once again. Surabhi.
As a woman, and like most women who pull our shoes, this is great because now if something was priced at, say, 2007-99 or 2008-99, the companies perhaps will have a lot of incentive to move it to under 2,500 to get the lower GST, which actually, let's bring in Mangalam on this, because look at Metro Brands, look at Bata itself. Campus anyway has been, a lot of its offering is under that price point of 2,500. But the shoes are walking, and so is the rest of the FMCG sector, Mangalam.
Well, the shoes are running right now, and rightly so, because, you know, what was earlier 1,000 rupees has now been increased to about 2,500 rupees in terms of a ceiling. And remember the important part, that majority of the organized footwear industry in the country, no matter the prices that we pay for our shoes, etc., is sub 2,500. So in terms of volumes, this number subsumes nearly 95% of the footwear volumes in the country, and a large chunk of volumes coming in for the likes of Bata, Relaxo. In fact, nearly all of Relaxo, or nearly all of Campus, etc., would be under 2,500 itself. So this stands to benefit all of them. The only fly in the ointment would be for the ones who are looking at premiumization, so the kinds of metro brands, etc., where the average selling price is a lot higher than 2,500 rupees. They may have to, either take the price down to 2,500 rupees or bear a bit of a dent in terms of higher GST or no change out there. The important part, but from an FMCG standpoint, I heard Prashant speak about two names, Colgate as well as Britannia. Two things are common between them and the GST rate coming down. The first part is that for Colgate, nearly 95% of their portfolio stands to benefit and come at the 5% mark itself, because it's toothpaste, toothbrushes, etc., all of them down from 18-12% to about 5%. So that's a positive. Even for Britannia, we have nearly 85 to 90% of the portfolio, which includes the likes of biscuits, cake, cheese, rusk, etc., down to about 5%. So these are, standout beneficiaries in terms of portfolio weightage or portfolio exposure to the rates which have now come down to 5%. But the second part is both these stocks saw a big gash post their first quarter numbers as well. So there was also headroom for an up move on both these counters. And these are also products which are more sensitive to prices because, in the Colgate form, the premium products, etc., which have been doing well. So mass consumption, there was a problem. There was a fair amount of competitive intensity. So prices coming down out here or perceived value increasing could boost volumes. And even the case for Britannia as well, 5 rupee biscuits, 10 rupee biscuits or 15 rupee biscuits, all of them are the ones which are most impacted by any slowdown in consumer sentiment and will benefit the most when there is a price benefit that comes by in terms of consumption as well. These are impulsive purchases, so there could be some volume increase or volume growth that we can see for both these counters.
Okay, all right, got that. Mangalam, thanks very much. Let's quickly get back to the auto space as well, because the biggest leaders of the rally are probably some of the auto names like Mahindra and Mahindra. We have Sud back with us. M&M really revved up, Sud.
So big GST reset, and the biggest, one of the biggest beneficiaries, the auto sector. In the auto sector also, three segments which are the biggest beneficiaries. First, tractor segment, second, SUV, and third is EV. And that's the reason screen is telling you why M&M is top nifty gainer. Even stocks like Scott's, Kubota, Swaraj engines, which are mainly to tractor segment, are up almost in the range of 8 to 9%. Now, what did GST do? GST Council has approved reduction across the segment. So small cars, motorcycles up to 350cc, auto parts, all these segments come in the slab of 18% versus earlier tax rate of around 28% plus cess. So smaller cars beneficiaries include Maruti, Tata Motors and Hyundai. Auto parts beneficiaries include Bell Rise, Endurance Technology and these companies. Even Tire also comes in the 18% slab, and that benefits companies like Apollo Tires, Seat, Balkrishna Industry and so others. Tractor has come to 5%. And that's the reason M&M is up. And also tires and the other parts which are used in tractor segment, that also will come in the 5% slab. Apart from that, EVs remain in the 5%. Then tanks and other armored vehicles. So of that, Tata Motors, Ashok Leyland and Bharat Forge are the biggest beneficiaries. Then high-end cars move into 40% slab. But it's very important. Now, even after moving into 40% slab, effective tax rate would be lower than the earlier rates. Because earlier, for example, XUV700 of M&M, 28% was the tax rate, plus 22% was compensation cess. So that's the reason effective tax used to be in the range of 43 to 50%, which now comes down to 40%, and that will benefit companies like M&M and also Maruti, because for Maruti also now almost 30% of total volumes come from SUV segment. Even Maruti is benefiting from small car reduction as well. Now for bikes, so up to 350cc reduction will benefit all the companies. So in this, biggest beneficiary is Eicher Motors, but there is a catch. for Eicher Motors, 11% of total volumes have the capacity of more than 350 cc. Now, surprising factor has come because earlier tax rate used to be 28% plus 3% compensation set. Now that has increased to 40%. So that is minor negative for Eicher Motors. So overall, it's positive for auto with minor few negatives.
All right, super explanation and great stuff there. Thanks very much, Sud. The sector is excited and so is Sud with what has been done. So lots of reactions. We spoke with Mahindra, more coming up through the course of the day. We'll slip into a quick commercial break and we come back once again and focus on the insurance space. PB Fintech's management will be with us. Shriram Finance is another management we will be speaking with on the sweeping GST changes which have been made. Stay tuned, coming up. Welcome back. We're now joined as promised by Umesh Revankar, Executive Vice Chairman at Shriram Finance. We also have Yashish Dahiya now joining us, Chairman and Group CEO at PB Fintech. We've been, of course, talking to a range of businesses, range of companies and asking them what the GST cuts do for their specific business. Mr. Revankar and Yashish, great to have both of you here. Yashish, if I can start with you. We spoke with Niva Bupa earlier and the understanding is that while this is great for consumers because that 18% goes away, from a insurer's perspective, companies are kind of circumspect because without the ITC, the input tax credit, will this actually lead to a slight increase in cost? And we put out some of these calculations earlier with Yash over the last fortnight or so in terms of feedback from industry. So looks like it's come to pass. I just wanted your thoughts as a as a platform. I'm assuming this does increase volumes for you. You're not, in that sense, affected by this. Go on.
So we are super enthused by this move. I think it's a great vindication for us because for the last 17 years, we have been saying protection, which is health and term, are the most critical products for the consumer. And the government acknowledging that and the government taking the GST away on those products is a very, very strong message. So I think none of us should miss the wood for the trees here. Whether there's a couple of percentage points of input tax credit or whether the price goes slightly below or slightly above, that's all fine. But the great message is that health and term, separated from many other products, are very, very critical for the consumer, and the government is not going to charge any GST on these two products. And thus, the consumer will definitely benefit, but more importantly, the message will get home that, look, these are important products supported by the government. And I think that is the key part here.
Yeah.
One can go through the mathematics of, look, think about it. In health insurance, a consumer can pay on monthly mode basis. And, there is the person can change the moment the transition happens. So I don't think there is any big difference. And yes, if there is some cost, I'm sure that there will be a discussion that the insurance companies will have with the regulator. See, the second point I will try to make is investors and analysts have read through most of this. And if you look today, almost everybody universally, whether it's LIC, whether it's HDFC Life, whether it's ICICI Life, whether it's Niva Bupa, whether it is Star Health, whether it's ICICI Lombard, and whether it is us, everybody's price across the board is up. That means people are seeing something positive. So I think the big message here is very, very positive.
Yeah.
And I don't think one needs to get too embroiled in the
couple of percentage points. And I think you put it well, woods and trees. But I just, with the forest. Yashish, just a quick point. As on a practical basis, health policies, for example, again, if I can use your analogy, a few percentage points of the abolishment, will this help in increasing penetrations? I mean, I don't think you're saying that somebody is not taking health insurance because you got to pay 18% GST. So, but
I don't think there is any consumer out there who was not buying health insurance at 10,000 rupees and just because it is 9,000 rupees will rush to buy health insurance.
Correct.
So I don't think it is about that.
Correct.
I think the bigger part is the message. The message is that this is very important for you. Even the government does not charge GST on it. And this is a very important product for you. And similarly, and even more importantly for term insurance, please appreciate this is the first time that term insurance has been carved out in a way, or something specific has been done for term insurance. Please appreciate it's a very small part of the overall life insurance industry is the pure protection element. And this is the first time that the pure protection element is being called out as term insurance is very important for you. The government, which used to charge 18% GST on term insurance, will not do so from 22nd of September. It's a very, very critical message. And I think that message should not be missed. And I think that message will go a long way in amplifying the importance of both term insurance and health insurance to the consumers.
No, absolutely, Yashish, take your point. It's a big, big step for policy buyers. It's a huge relief, right? And this is what we were discussing with Niva Bupa, with Ankur, just a while back. That, now that as a policy buyer, since I have the additional cushion, maybe I'll buy a bigger policy, bigger sum assured. Maybe I'll buy a, more higher value-added policy. But the question here is that unless there is a tweak and this input tax credit business is resolved, who bears the brunt? Who bears the pricing? Now, one company we spoke to said that we're not going to hike the premiums just now. So will it be borne with the distributor? Could it be, and you're a big sort of player in the entire ecosystem. So could some of it come to you as well? What happens in the interim? There's this 18%.
I think totally missed point, I would say. Really focusing on an irrelevant matter compared to the big matter. I think for us, it's a question we haven't even thought about. And it's perfectly fine if there is a plus or minus that happens on that. The clear message that you can see both from the markets and from us is that this is a super positive move for the messaging. I do not believe, unlike what you just mentioned, I do not believe a customer buys a policy because it is 10% more expensive or 10% less expensive. I don't think that is the reason at all. I think it's the messaging which is very important. That look, health insurance and term insurance are very critical for you. And I think as long as we focus on that, and if you look at, and that's what I said, right? If you look at the markets are rewarding everybody today.
Absolutely, because the larger point, like I said, and we've discussed that as well, we've highlighted that largely when the price goes down, you will insure more, you will buy more, because that need has been well understood. Coming back to you, Yashish, in just a second, let me also bring in Mr. Revankar into the conversation. So, morning, great to have you on. So the market is also very excited about all the financiers, right, who will be catering to whether it's auto demand, whether it's consumer durable demand. As of now, what do you anticipate? Third quarter, basically September 22nd onwards, when these cuts kick in, what can be the additional boost to the lending for you specifically on the consumer side of your business?
Yeah, thank you. What I believe, I agree with Mr. Yashish's view. It is the sentiment and messaging is more important. I think a positive sentiments and the messaging done will create a demand. That demand is not just because of the pricing point. Pricing point is not important. It is what is essential for you and what it gives you back. So I think the positive environment and higher economic activity will bring in more business. I believe the third quarter is likely to be much bigger compared to even the previous year third quarter. And because the sentiments will be much positive. And I think the environment can reinvent itself to a higher consumption.
So, sir, some indication, third quarter, what is the growth in disbursements, overall AUM, what will you expect given this big bonanza?
I do expect, we have been planning for 15% growth year on year. We should be able to grow maybe a higher number at 17-18%. It all depends upon economic activity per se. But I think definitely we will cash on when the sentiments are better.
Mr. Yashish, this is Yash Jain. I want to come to you. You, of course, spoke about, not missing the forest for the trees. clearly, it is a very big positive for policyholders. But, just not missing the shareholders for policyholders also. And from the shareholder point of view, I want to understand something. The government, of course, is clear that profiteering shouldn't happen after this cut, which means the benefits of that 18% cut when it comes to GST should be passed on to policyholders, which means our calculation suggests that about 5 to 7% of cost will come to insurers on health insurance, and about 10 to 11% of cost will come on term life insurance. Now, if profiteering can't happen, then cost will, of course, have to be shared between the insurer and the aggregator like yours, because commission is still not exempt, which is paid to you. Can you help us understand this thing, how it will be shared between the two parties if it can't go to the policyholder? And second thing, I just want to understand what happens thereafter, because you said that volumes won't go immediately after this cut, right? Insurance is not a product like that. So is it a double whammy in the sense that volumes don't go up, at the same time some additional cost comes on your books?
Yash, every time I speak to you, I love the focus on commissions. Do you know how much profit we make? We make 1% of premium as our profit. Is that too much? 1% of premium. That is our profit. Right? Is that too much for everything we've done for the last 17 years? And our accumulated company is still in losses. Right? Yes, when we do 1 lakh crores of premium, of course, 1% will also be quite a bit. But it is 1%. That is what we make. Right? So it is not like one is making too much money or anything of that sort of profit. Terms like profiteering, etc. do not. Which insurance company is making crazy profits? And which distributor is making crazy profits? Right?
Yashish,
but sir, the point is it will have to be shared, sir. It goes back to...
Let me just finish off on that, right? If the benefit is 18% and the cost is 5% or 10%, a benefit is going to the consumer, is it not? Right? Whatever the...
No, correct. The benefit is going to the customer, the policyholder, definitely. And that's what I started with. But what happens to the company also? That's also important for the shareholders.
And you are already seeing the company reaction. There are people who are smarter than both of us who are actually investing. And they are all giving everybody a 3 to 6% increase in share price. So that means there is some benefit that we are missing. That is actually going to the insurers and the distributors from this. And that is the benefit of the message. You know, whether you look at Star Health, whether you look at Niva Bupa, everybody's up today. Nobody is down. Neither is...
Yashish, you surely are not. I know that you're not the one to look at stock prices and make a determination.
No, but
today you're doing that.
It is an indicator of what the investors are thinking.
Yeah, I completely agree.
And Yashish's point... reaction is. So I think we are very stuck on one point. Input tax.
No. It is. We began by saying this is absolutely great news. When I renew my policies, I will pay less. I'm delighted. And I think most people...
Tell me one thing. Would you buy a policy or not buy a policy because it is 5% cheaper or 5% more expensive?
I told you, I said, it. You're repeating my words. I said no. I mean, that is not the point. This is a limited point which Yash was making, that for insurers, is there a cost to be absorbed? That's all.
Yeah, I think for media it is important not to focus on limited points and focus on larger points.
Okay, Yashish, I'll still continue with my point.
We can focus on how will reinsurance cost change, how will we can go into all these details.
No, correct. So it's well understood by the industry, Yashish. Though it's big positive for policyholder, there is some cost to be absorbed by insurers, and maybe some of it will come down to aggregators.
And that benefit will come from the higher volume. I think what Umesh said was very relevant. I think we will all have a great Q3.
Yes. Just Yashish, just one number very quickly. How much does health contribute to your value and revenue, and how much does term life contribute?
About 60% of our value is health insurance, and about 25% is term insurance. So these two products are 85% of what we do in terms of value. Also, 85% of our media spend is on these two products alone, health and term. So health and term, please appreciate, we have been in various government meetings for the last 15 years, always requesting that health and term have a separate carve-out. And we are really pleased that it has finally happened. It was like a baby who was making a noise. Nobody was it's finally been heard, which is very, very good.
I think also if I could weigh in on the debate that you three gentlemen have been having, and I mean, as someone who tracks personal finance and has only the policy buyers' interests in mind, and we've seen this, happen day in and day out, that when that premium is, say, no longer 15,000 rupees and it comes down by 18%, the industry has a way of adding more goodies for the same price tag.
Absolutely.
Yeah, so we've seen product innovation, we've seen reassure plans, we've seen plans which give you no capping on room rates. There is so much product innovation going on, and that someone which has gotten attuned to paying 15,000 maybe will still pay 15,000 for a better policy. And maybe that's what the market is also picking up on, and we'll see how that plays up. But Mr. Revankar, he's been very patiently listening into this spirited debate. Sir, just coming to you specifically, because this is such a big change and it's going to be an ongoing change. Revise our memory. When you talk about, say, consumer-facing finance, or, actual consumer finance for you, what percentage of your book would that be? And will the mix change in any way? When you talk about retail-level auto, or even if it is, because even on buses, etc., GST has gone down on everything. So will your lending mix over the next 2-3 quarters change in any way?
Yeah, there is likely to be some change in the lending mix. Maybe there will be more new vehicles will be financing, because some of these segments, some of them who are not really upgrading their vehicle, they may come forward. So I have seen in certain part of the country, many people are postponing the upgrading of their vehicle, either buying new vehicle or newer vehicle. So that momentum will come, and that should really create a better demand, credit demand. I see there will be a lot of change in the way people do business going forward, and better compliance itself will bring more business, because many more industries will not be happy to play safe with the compliance, and that will create, I think the MSME segment especially will get a very big boost, because there will be a lot of consumer item that has come into lower slab, and the consumption will increase, more compliance, more movement of goods. So I feel it is an extremely positive move to bring down the slab, make everyone comply, and grow the demand. I think sentiments will be very, very positive.
All right. Absolutely. One hopes that overall there is lots of savings and this better affordability across the board, across sectors, and it shows up in different ways, as we've been saying, boosts consumption, which I think is the need of the hour. Yashish, thank you very much. Always spirited, always great speaking with you. Umesh, thank you very much as well. We'll take a quick commercial break here. We're going to come back on the other side, and we'll get into some of the tax aspects, right? We want to clear some stuff. So MS Money of Deloitte India will be with us. Saurabh Agarwal of EVA India will be with us as well. Stay tuned.
Welcome back. Well, let's get into the taxation nitty-gritties now. We've got MS Money, partner GST at Deloitte, and Saurabh Agarwal, tax partner at EY. Gentlemen, thank you so much for joining in. Mr. Money, it's a landmark day, right? And we've been tracking and tracing the history and the evolution of the GST framework with you for so many years now. I want to straight away get to the biggest debate. And if you could hear the previous speakers, I think you'll already know that. The question is, what happens to goods or services that have been moved to either the 5% category or the exempt category, and they don't have the benefit of input tax credit? Insurance is obviously one such big space, but how should we look at it, and how should we interpret this, Mr. Money?
Okay, so let me first speak on insurance, because insurance is very different from all the other products and services which have been moved. As far as insurance is concerned, what we need to understand is that the overall input tax credits for an organization are across all policies, and there are only few expenses which may be in respect of specific policies. So here what has been exempted are typically health cover and term cover. Now, health cover and term cover may have a few expenses which are directly attributable to it, on which obviously there is no question of an input tax credit. but there would be a large amount of other expenses which would be common for the entire organization. And the debate is in respect of the proportion of those common expenses that pertain to the health policies and the term covers. When we do that calculation and when we do that math, and it may not be identical for each insurance company, the proportion of their health policies and the proportion of their term cover policies sold may be different. It may be different in respect of health cover sold by general insurance companies and health cover sold by life insurance companies. When they do that math, and I think it is a little too early for them to do the math because this has happened only last night, they will come across a proportion of credits that they may not be entitled to in respect of the common credits. Now, bear in mind, till now, we are not aware of anything in the 80-page press release that was issued yesterday, which says that there needs to be a reversal mechanism for the common credit, but that is expected in any case, to be there. Now, the proportion of credits that they need to reverse, once we have that number, is when this debate can actually have some numbers attributed to it. Is it going to be 2%? Is it going to be 5%? Is it going to be 8%? That number will need to be worked out. And as I said before, it will not be a uniform number. It will vary across the company depending on their product portfolio. But the larger issue is now all the insurance companies will now need to rework their products and go back to IRDA to get an approval of new products, because some of the old products cannot be sold after 22nd of September. So when they do that pricing, as was mentioned by one of the speakers in your earlier session, when they go back to IRDA, it's quite possible that the insurance companies bundle more services or more features in the existing products at the same price. And there may be some products where they pass on a larger part of the reduction to the customers.
Right?
But
net, to try and keep it simple, Mr. Money, in the current form, let's talk about a standalone health insurer. In the current form, because for a standalone health insurer, all the policies now go into exempt category. So will there be a hit or not? Because as of now, there is no input tax credit. There would be some cost that insurer would have borne to provide that service, on that premium. So will, say, a standalone health insurer in this case be entitled to anything, or what happens to the cost? Or will it just have to be either borne by the insurer or the distributor or eventually passed on?
You're bang on. So for a standalone health insurer, there will be a cost attributed to the exemption. There will be a cost attributed to the exemption. But when that cost is attributed to the exemption, the view is that, one, they might tweak the products and add some more features to the product. The second aspect which we have to bear in mind is, if a person is buying a policy which is costing, which has a premium of 1 lakh, and that product cost today to the customer is 1,18,000, because in real sense, the customer does not care 18,000 is GST or 10,000 is GST. The customer says, I'm paying 1,18,000 premium.
Yeah.
Now, this customer, if he even reduces the premium, and if the premium, let's say, comes down to 1,05,000, what's going to happen to the 13,000? Two things could happen. One, the product becomes richer by adding more features, coverage, something.
Yeah.
So it remains at 1,05,000. But for the customer, the remaining 13,000 goes into buying something else, maybe consumer durables, which have also come down. So that is where the whole focus of this stage of GST reform has happened, because the intention clearly is to incentivize consumption. That seems to be the whole focus.
Absolutely. Okay, let's quickly move on and talk about the overall implications as well. Saurabh Agrawal is also with us. Saurabh, what's your sense? And also just throw light on the fact that for tobacco products and cigarettes, it continues to be tax neutral, right? And to that extent, I think for some time, the compensation cess needs to continue. Once again, I mean, what is the fine print, and would you expect any changes at all when it comes to taxation on cigarettes? Because this national contingency, calamity duty, etc., a couple of other things were also contributing to, say, the cost of one cigarette. So what happens there?
So, before I answer your question in a specific, 5 words which I'll use: monumental step, commendable, unanimous, clear intent, proactive approach, with 2 themes which are overall overarching. First is trust, which is between the state and the center. Second, trust between the industry and the government by not coming up with anti-profiting provision. And the other theme is the India consumption story, which continues, which will ensure that whatever was the impact on account of global tensions on our GDP will get mitigated to a large extent. Now, coming to your second question around the tobacco and tobacco-based products, as of now, the fine print says that for them, the tax rates continue as they were till the time the final compensation on interest and loss with the state exchequers is settled. With respect to the clarity, whether the compensation sets will continue or not, as on date in the fine print, there's no such clarity available.
Okay, all right, got that point. Gentlemen, also just quick thoughts on overall the revenue foregone, I think is to the tune of almost 96,000 crore rupees. You can share the exact number. Do you think largely this will be made up by more buoyancy, more consumption of goods and services, or to what extent will this be a loss that simply has to be borne? What do you make of the revenue neutrality aspect? Because right now it's not revenue neutral. Quick point, Mr. Mani.
So the way I look at it, I'm very, very bullish in terms of, I would say much more than the revenue loss being made up. And whatever be the number, and I'm basing this on 2 points. The first point is the earlier time when we had such large rate cuts was in 2019, where a lot of products came down from 28 to 18, and that was, massive at that point of time. Now, if you look at the empirical data, you will see that prior to the cut, GST collections were averaging those times around 70,000 to 80,000 crores per month. And now we have GST collections which average between 1,80,000 and 2 lakh crores, per month. So I think the data indicates, the empirical evidence very clearly indicates that when you reduce rates, the consumption certainly goes up. And the consumption which goes up may not be in respect of the same product category. There may be some premiumization which happens. People could move to other product categories. Because of the income tax related changes a year back, people in any case have more disposable income. And when they have more disposable income and when the economy is growing, there will be an inherent tendency to have more consumption. And what this has done is to fire up that intent like anything. And that is the reason why I would say that GST to me today stands for a genuinely simple tax with a great sense of timing.
Would you concur, sort of very quickly? Mr. Mani is saying that the buoyancy, and he gave a great example as well, how the tax collection numbers have moved, that the buoyancy in the economy, consumption, will more than make up for the revenue that the states and centre are currently losing.
I completely agree with Mani. If you see the tax base has doubled in last 8 years, it has moved from 60,000 registrations to around 1.5 lakh registrations. I'm sure with the tax rates coming down, the number of registrations will further increase and it will lead to increase in taxable base. Further on the tax buoyancy also, if you look at it, has increased from 0.6 to 1 effectively. And if you see in the months of April and May 2025, we went in for the record collections of 2.36 lakh crores and 2.1 lakh crores overall, while the government might be estimating some bit of dip in terms of around 48,000 crores as a net dip on collections. But I foresee that with increase in taxable base, we should be able to meet even that dip.
Okay, all right. So tax buoyancy perhaps will bounce back, will come back as the consumption patterns really get a boost. Thank you very much, gentlemen. Good to have that perspective from you. Well, with that exhaustive session, we are winding down on this edition of Bazaar and leaving the market about 130 points up on the Nifty. Don't go anywhere. Continued coverage of the mega GST reforms continues right after this break.